Into Europe on that front. We'll look for a read across from China.
I will show you how to get the best funding for your startup idea.
Crayon Group. So we've seen Software One over in Zurich going after Crayon Group, which is an IT services business in Oslo. A little bit of M&A to close out the week, perhaps then, Guy.
Cool name, Crayon Group. Love it. Let's talk about this market open. Here we go. It is time for the opening trade here in Europe this Friday the 13th. This is what we are looking at. We're expecting a cautious open. The FTSE 100 may get affected by the pound move you've seen this morning off the back of disappointing GDP data, but at the moment, absolutely flat as a pancake. Nothing to see here. Nothing going on. Absolutely flat, as is the IBEX. Wow, we've had some cautious opens recently, but this is a very cautious open. We're down by 0.2% on the stock 600, so a little bit more weakness maybe showing up there. We'll see what the CAC delivers. We're waiting to see what exactly the French Prime Minister's, what the French Prime Minister's name is going to be. We'll wait for the DAX. We'll wait for the SMI. The CAC's down by 0.2%. Little bit of cautious trading here. What are we waiting for? I wonder. What is the signal that is going to get these markets moving throughout the rest of the day? Got a lot of the catalysts already this week. Friday feels maybe a little bit more cautious, Anna.
Yeah, Friday does feel cautious, and a really interesting breakdown of sectors here, because we do see some of the things we're expecting at the bottom of the sector board, which is almost all red. We do have a few in positive territory. We do see consumer products and services, and we do see basic resources. So those two sectors were in focus for us because of the China news flow, because of the disappointment around China through the Asia session. Also healthcare doing badly, and often when you're feeling kind of risk off and there isn't a huge amount of specific reason, okay, there's China, but there aren't specific other stock specifics to factor in. Healthcare sometimes provides some resilience then, but healthcare stocks are weaker, and we'll watch for details of why that might be. But basic resources, the worst performing sector right now, down by 0.7%. Rio Tinto is weaker. Perhaps the China link there. Consumer products and services, yes, some of the luxury names, Moncler, Burberry, Bruno Cucinelli, which was a big gainer yesterday on the back of its numbers, also a little bit weaker this morning.
Banks are a little bit higher this morning, not by much. There's a big story kind of coming out of the States about deregulation around the banking sector, and you do wonder whether that would further open up the gap between what US banks and European banks are doing at the moment. European banks have had a sort of great run on returns to shareholders. That now seems to be running out of a little bit of steam right now. In terms of the points story, SAP is the biggest points gainer to the upside. Huge driver, of course, of what we've seen in the DAX so far this year, as has been Siemens and Siemens Energy. Siemens Energy is up quite nicely as well. Some of the banks are trading higher. BBVA up by 0.7%. Novo, LVMH, Astra, Rio, Roche. So pharma, as you say, and the miners under pressure.
Yeah, SAP, is that tentative read across from what we're hearing from Broadcom? Is there a tech theme that does translate? Yes, some strength coming through in some of the banking stocks. Is that a reaction to a more mixed bond market picture this morning than what we saw yesterday, where we saw some fairly sizable moves there? Maybe not linked. Rio Tinto is one of the drags on the market, and that does no doubt link to the commodity story that we've seen overnight. Thinking about commodities, where they go, and inflation. The risk of inflationary pressure from a potential ramp-up in tariffs from President-elect Donald Trump remains in focus, with just weeks until he takes office. ECB President Christine Lagarde shared her view from Frankfurt yesterday.
Restrictions on trade, protectionist measures are not conducive to growth and ultimately have an impact on inflation that is largely uncertain. In the short term, it's probably net inflationary, probable, but the overall impact on inflation is uncertain.
Joining us around the table this morning, Aaron Captain, who's the Global Head of Economics and Strategy Research at UBS Investment Bank. Aaron, very nice to have you with us as we bring 2024 almost to a close, not quite there yet, still a lot going on, isn't there, as we wait for another Trump presidency. We just heard there Christine Lagarde talking about tariffs and the risks associated with that. Your base case, I think, is that we do get tariffs on China. That's been much talked about by the incoming administration, but not on the Eurozone or not to a great degree. Talk us through the assumptions that you're making.
Yeah, so for China, we've probably got the highest tariff in our baseline, so 60%, but we're excluding 25% of the Chinese goods, which is effectively what they did in 2018-19. Doesn't make sense to tariff the goods where China has 100% market share, right? There's nothing else to buy. For Europe, so we do think European tariffs are coming, but they would be part of a global tariff. And so if you just think about the amount of manpower that's required to implement just the China tariffs, right? You have 10,000 tariff lines. You have to seek corporate feedback on every single tariff line that goes up. It's going to take many, many months. So if you want to do a global tariff, I think on which the legal basis is pretty shaky, sequentially, we just think that comes much later, if it happens at all. Now, if they abandon the global tariff idea, then I think you would see something narrower on the countries where there is actually sort of a structural trade surplus issue, which is Europe, right? And so we've just left it out of the baseline for now until we get some clarity from Trump.
It's really interesting reading your notes that you put quite a lot of emphasis on a number of these detailed factors around tariffs. Whether Europe retaliates is going to have a key impact, and whether the tariff is global or Europe-specific has actually an impact through FX channels and through impacts on growth. Talk us through your thinking there.
Yeah, so I think the uncertainty that Lagarde just displayed in that clip, I think that's correct in the sense that if you have a Chinese tariff going up much more than all the other tariffs, then it's likely that the Chinese currency depreciates more than the other currencies. And that would mean that all of the Chinese imports into Europe become cheaper. And that can actually offset the inflationary impact of potential retaliation. And so when we run the models, that's exactly what happens. We have virtually no inflation impact. We have predominantly a growth impact, and that's all. So before you get to the uncertainty that Lagarde talks about, which I think actually makes it much easier for the ECB. If it's mostly a growth shock, non-inflation shock, you just ease more. If you're the Fed, it's actually both, right? And you're sort of stuck.
Is the U.S. economy stronger or weaker in this scenario?
So it depends how many tariffs you do, right? So I think if you just do the China tariffs, it's absorbable, right? It'll be 0.3 of growth drag. You offset it with tax cuts. It's not a big deal, and I think the market can sort of take it in stride. That doesn't look to me like that's all that's going to happen, right? We've already seen the announcement of sort of 25% on Canada, 25% on Mexico. Those aren't even trade tariffs; those are border tariffs. But the ease with which these tariffs are being thrown out and the magnitudes are just so much larger than 2018-19, right? In dollar terms, if you just take what he campaigned on, 5 times larger than 18-19. And so I think there's sort of excess optimism because in 18-19, there was this ability of corporate sectors to absorb these tariffs in the profit margins and not really pass it on through the supply chain or to consumers. That will not be possible, right? And so if you do, just that rest of the world tariff at 10% and you do China, you're talking about 150 basis point increase in the price level, right? So for U.S. inflation, so as an annual year-on-year delta, that's about 100 basis points or so. Yeah. You're looking at, and then it comes down to the retaliation. So you're then looking, I think, at a domestic demand drop in the U.S. that's 1.5 percentage point versus the baseline, and that's with low levels of retaliation. If you have high levels, the numbers sort of get really big.
I also, because the nowcast data at the moment in the States points to a kind of high 2s, low 3s GDP growth next year. There's no sign of a recession. Everybody's seeing the potential to look through some of this stuff. As you say, there's a kind of optimistic steer being put on most of it at the moment by a lot of people I'm talking to. Is there a material impact on that nowcast data that could come from this? Would it be enough in magnitude to cause a recession? It doesn't feel like it, which means that the U.S. economy just kind of continues to motor on.
I think we're sort of pricing all the wishful thinking right now, which is that, and partly it's rational, right? So if you look at the personalities on the economic side, the fact that Lighthizer has not been given the cabinet position, I think, is sort of material because if you think back to the last administration, it wasn't clear ex ante who was going to win out and have Trump's ear in some of these trade restrictions. And so I think it remains to be seen. I think some of these people who've been appointed, like Scott Bessent and some of the others, they are sort of more transactional, escalate to de-escalate, and you can then sort of have some hope that this doesn't get out of control. But I mean, some of these other personalities from the last administration, it was not transactional, right? This is a generational, multi-decade thing where they they see China as a strategic competitor, there is no deal, right? So I think we have to sort of see where exactly that plane lands. And it is not obvious to me, listening to what the administration officials or incoming officials have sort of said the last couple of weeks, is that they've abandoned the idea of imposing tariffs on many other countries, right? And so I think we sort of need to see what happens. When we look at assets, there's only 2 assets in the world that are sort of in line with our forecast, which is oil and Chinese rates. Every other asset we look at is basically more optimistic. So I think we're not really pricing the tariff risk.
We're not pricing that tariff risk. And where does that leave stocks? I think, have we seen markets sort of front-running the good news then and bringing forward gains that we might have seen in 2025 into 2024?
So that's exactly our view. So we think we've actually, even compared to sort of historical templates of what should the market do when the Fed cuts, et cetera, we are so far beyond that now. So we really, I think, have pulled forward all those returns. And I think you're now quite vulnerable early in the year to all the announcements that are coming, right? So we, for the S&P, we think there might be a little bit of consolidation phase, a bit of a pullback. So we have a little bit of rotation in leadership from the U.S. to Europe. Europe, I think, it's not as bad as people think, right? So that can get a bit better. But so, yeah, I think there is now sort of a sensitivity to what exactly gets announced after the inauguration.
Every other asset, other than Chinese rates and oil, is too optimistic at the moment.
Well, implies we have a forecast of 2.9% growth. Every asset we look at implies more than.
What's the most over? What do we think is the furthest out of kilter?
Credit spreads are pretty far out of kilter, right near all-time tights. I mean, and then we have various ways of looking at the equity market. So there's various ways of slicing and dicing it. But so equity, credit, it's all very, very optimistic.
What breaks that credit trade then? Because we keep talking to a lot of credit voices in the last couple of weeks, and they're all still quite positive. And
and we actually only, again, it depends sort of what happens, but so we have credit spreads modestly higher. I think the debate is, do they go higher at all, right?
Yeah.
And so
because the strength of the U.S. economy might be one thing that Trump does deliver, seems to be the market's thinking.
Yeah, and so the other things that sort of look really optimistic, volatility, right? So when you zoom out, when you zoom in, it looks like volatility went up the last couple of months. But when you zoom out, I mean, 1 year forward volatility for Europe, incredibly low on sort of a 10-year horizon, right? The only asset that I think has sort of started to price a little bit of the tariff risk is break-evens, but only at the very front end, and only really, I think, sort of partially China. Right? Beyond that, it's really hard to find where we're pricing the risk.
It's going to be an interesting year. It's going to be a fascinating year. Aaron, thank you very much indeed for joining us around the table, setting us up nicely. Aaron Captain, the Global Head of Economics and Strategy Research at UBS Investment Bank. Core 6 looks a little bit like this morning. Let's talk you through the price action that we're seeing. It's a fairly cautious Friday that we're seeing, certainly when it comes to an index story. Nestle continues to go lower. 52-week low after 52-week low there. LVMH is a little softer as well. That Chinese consumption story not being priced into Europe this morning. Ferrari's up a little bit. The chip story, I didn't see it this morning. The read across doesn't seem to be there. And the pharma space is under quite significant pressure this morning. Novo down by over 2%.
That's going to move the healthcare sector, isn't it? A big move in Novo, the size of business that is. Coming up on the programme, Europe's falling behind. This week's documentary from Bloomberg Originals takes a look at the missing trillions as a result of lacklustre growth and productivity. Could this impact the continent's standing as a global economic powerhouse? We will discuss. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back to the opening trade. It is Friday morning. We are seeing some negativity across some of these markets this morning. The overall picture down by 0.2% on the stock 600. It's a little mixed, and we're weighed down in France by possibly what is happening on the luxury side of things. So let's have a look at some of the stocks that we're watching, some of the sectors that we're watching this morning, and the luxury space is one of those. We see weakness on Moncler, Bruno Cucinelli, Burberry, L'Oreal. So it isn't just Paris, but Paris tends to do badly, and a lot of the losses concentrated there, as you might expect. That move in LVMH and the like will be taking substantial points off the CAC 40. So it's down by 0.2%. And this all guy connected to the China story, a lack of detail coming through from these Chinese meetings around fiscal stimulus.
The miners are down on the back of that as well, so that seems to be the other logical trade that we're seeing coming through into Europe this morning. In terms of kind of the names that we're watching, as you can see, you've got Rio, Anglo and Glencore all tracking a little lower. It's really interesting the spread that's within this space at the moment. The steelmakers, SSAB, down by nearly 40% so far this year. It's interesting that Antofagasta is absolutely flat on the year. Anglo American, obviously we've got the M&A story surrounding what happened there, up by 27% so far this year. So there's actually a really big spread. And you would have thought that China would have been the biggest effect, but there are other factors that do seem to be maybe coming into play and maybe sort of causing a little bit of differentiation within this space, which doesn't seem that represented on the screen in front of you this morning.
Yeah, this morning they're all just down a bit, aren't they? Let's talk about the insurance sector then, Guy, because we have actually some positive news from a couple of big reinsurers, Swiss Re and Munich Re, both of those businesses putting updates out to the market and both of them being well received. So Swiss Re shares gaining this morning after the Swiss insurance company posted targets for 2025 and gave us dividend commitments, all of that being welcomed by investors. And Munich Re, again, targeting net income of 6 billion euros next year, talking about good operational performance in all of its business segments. So positivity coming through from the reinsurance space.
Not much positivity in Europe more broadly, though. So let's talk a little bit about that. The EU's low productivity and failure to invest have led to a decade of lost growth. With France and Germany in crisis, the continent risks losing its seats at the table of global economic superpowers. So Bloomberg has taken a deeper dive in this week's Bloomberg's Originals documentary into this story.
The news for Europe just keeps getting worse.
The French government collapses, plunging EU's second largest economy into turmoil.
France's political upheaval in December offered another glimpse at fractious European affairs.
Germany's under pressure and Volkswagen workers are striking hard.
In my view, we are already in a crisis mood.
Our former model is over. If we follow our classical agenda, we will be out of the market, I have no doubt.
The EU's economy is now fighting for survival and struggling to keep pace with the US and China.
Had the European economy
grown as fast as the American economy over the past couple of decades, we'd be generating 3 trillion euros of extra income every year.
That's roughly the equivalent to the total GDP of France being routinely added into the economy.
Europe needs to have a digital era economy with companies that challenge those from China and from the US.
Without that, the region's at risk of being unable to afford to protect itself in a world where security is no longer guaranteed.
It's just a very tense moment for the world, and Europe's at the center of it.
The voice there of Kriti Gupta, of course. That was the abridged version. You can catch the full Bloomberg Originals documentary on Europe's missing trillions. That's on Bloomberg.com and on the Bloomberg Originals YouTube channel. Sticking with the growth issues that are faced by Europe, Christine Lagarde also weighed in on the European growth story after yesterday's rate decision.
But the latest information suggests it is losing momentum. Surveys indicate that manufacturing is still contracting, and growth in services is slowing. Firms are holding back their investment spending in the face of weak demand and a highly uncertain outlook. Exports are also weak, with some European industries finding it challenging to remain competitive.
For more on the state of the European economy, let's bring in Bloomberg's Jana Randau, who's in Frankfurt for us. And Jana, we'll probably come to some of the market responses and the commentary in more detail around the ECB and from the ECB yesterday. But just lingering on this idea of Europe's lost billions. And we did hear Christine Lagarde then talking about Europe losing momentum. Remind us, though, how front and centre the growth story is for the ECB. It has an inflation target. How much can it focus on the growth story declining?
Well, it can, simply because inflation is very, very close to the 2% target. Christine Lagarde said she is not ready to declare victory just yet, but in fact, inflation is very, very close, fluctuating around that 2% level. And the ECB changed its official policy language yesterday, saying the focus is now not on bringing it back, but on stabilizing it at that level. So essentially, we're there, and that opens up the floor or the room for the ECB to then look at the economy, look at what's happening with consumption, with investment, and making sure that financing conditions are not too restrictive and actually are, in a state that they can help the economy.
Jana, is there any sense that the ECB is waiting for Trump to arrive before it delivers a 50 basis point cut?
I'm not sure that there is a lot of appetite for that 50 basis point cut. Policymakers are very clear in arguing in favor of gradual steps in a way, adding a little bit of predictability to a very uncertain environment. And if you talk to economists, they say, just from the macroeconomic backdrop, it doesn't really matter if you go 50 here and then wait, or if you go on a steady 25 basis point path. So I think for now, the expectation is that we will continue to see those 25 basis point steps. Of course, if something really bad happens, if there's another shock, another absolutely unexpected event that is threatening damage to the economy, I wouldn't exclude it. But for now, I would say it's just a risk scenario.
And Jana, how do we sense that the ECB is weighing up the political risks, whether they come from President-elect Trump and the tariffs that are proposed, or they come from closer to home and Paris and France, where we're still awaiting news of who will be Prime Minister?
Yeah, I think the fear there, or the concern is tremendous, and partially probably also because they're entirely powerless and really are at the receiving end. Trump is a risk on the trade side, but also on defense and security, of course, because we don't know what he's going to do with or how he gets involved in solving the Russia-Ukraine situation, what he might do in the Middle East. So it's just a very big wild card in terms of foreign policy, in terms of trade policy. And then, of course, closer to home, the ECB has some sway. It's a powerful voice in Brussels as well, urging for those reforms that also the former ECB President Mario Draghi identified in September, saying we need those reforms. We need more integrated capital markets. We need more investment in the energy transition, in digitization, or Europe will die of a slow, face a slow agony and die a very slow growth. So the awareness is there. The chance of doing something on the ECB side is very small.
Jana, great stuff. Thank you very much indeed. The awareness is there. The action we await. Jana Randall joining us on the ECB. So the good news just keeps coming for Rachel Reeves, the British Chancellor. We've got some data out this morning. Britain's economy contracted for the second straight month in October. You don't often see that. The economy has only grown in one of the 4 months since the Labour government took power. Joining us now, Bloomberg's UK correspondent, Lizzie Burden. What happened this time?
Well, the decline's down to manufacturing, construction, mining and quarrying output. That's where it's fallen. And you've seen bits of offsetting from telecoms, logistics and legal firms, but, you know, not enough to spare the Chancellor this embarrassment when, of course, growth is the top priority of the government. The response from the Treasury is that we're determined to deliver economic growth. Higher growth means increased living standards for everyone, everywhere. We know that. That's exactly what the previous government said. This is the sort of language you hear before the election, right? We've been hearing it for months. The data, very difficult.
Yeah, what is the outlook ahead then, Lizzie?
This is what's interesting. So economists are divided. I've had a note from Deutsche's Sanjay Raja saying that there's probably more bad news on the horizon. He's pointing to all of this pessimistic survey data. He notes that the picture for the fourth quarter from the Bank of England and the Office for Budget Responsibility isn't as pessimistic as that survey data. So he says the risk of a quarterly contraction is no longer negligible. And that contrasts with Dan Hansen, our very own chief UK economist. He says that growth is likely to pick up into 2025 on the back of Rachel Reeves' looser fiscal policy. And he says that this isn't really likely to move the dial for the Bank of England. So such big questions as we go into 2025. You just asked Jana Randall whether the ECB's holding its horses to see what Donald Trump does in January. It looks like the BOE is going to stay on hold next week as well.
Yes, and so there'll be lots more from the Bank of England next week, won't there? We'll have a lot more of that conversation. Lizzie, thank you very much. Bloomberg's Lizzie Burden with the latest on the UK. Coming up on the programme as Europe ponders a future with less support from across the Atlantic, we speak to the CEO of the German defence firm Hensoldt. We've heard some quite stark language from Mark Rutte at NATO over the last 24 hours, so we'll work that into our conversation as well as the Capital Markets Day that this business held just this week. That's next. This is Bloomberg.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Minutes into the session, let's talk about where we are with the European equities this morning. As you can see, we're going nowhere in a hurry. In terms of the numbers we're watching out for, we're reasonably flat, as you can see. You've got the DAX up a little bit more than most. You've got some of the big names in Germany doing fairly well this morning, including SAP, which is continuing to lift that German market. But the Stock 600... absolutely flat as a pancake. Let's talk about what is happening with defence stocks, which have certainly had a good year, and German defence stocks in particular have stood out. European NATO members are ramping up defence spending as the group weighs the possibility of less support from the United States under a Trump presidency. NATO Secretary General Mark Rutte put his members on alert with this stark warning.
We are not ready for what is coming our way in 4 to 5 years. We can prevent the next big war on NATO territory and preserve our way of life. This requires us all to be faster and fiercer. It is time to shift to a wartime mindset and turbocharge our defense production and defense spending. Russia is preparing for long-term confrontation with Ukraine and with us.
We need to be faster, we need to be fiercer, and we need to be on a wartime footing, according to Mark Rutte, the NATO Secretary General. Ollie Crook's been all over this story all year. Let's talk about how ready NATO is and how it could factor in those Rutte warnings.
Yeah, we need to be in a warlike mentality. We need to also buy European, right? This is another part of the plank of the Draghi program. This is part of the sort of European defense build-out story. But there's also a sort of fundamental chicken and egg problem here, right? On the one hand, these companies, these defense companies, need to have the visibility, they need to have the backlog, they have the orders in order to ramp up, while the governments need to know that they can actually get the hardware that they need from these companies. So this is a sort of dilemma that I think the Europeans are facing, while we don't really have a sort of concrete financing program or really collective program at the EU level. And this is really what a lot of these companies are grappling with. So we're very happy to be joined by one of these companies, Hensoldt, which is one of the sort of great Mittelstand companies of Germany. They do sensors for the battlefield. They're really the eyes and the ears of the battlefield. They're sensors for ships, air defense, for kind of going in all over the battlefield, but also increasingly the nervous system of the battlefield, right? This is feeding huge volumes of data, mapping out digitally what's going on the battlefield. So we're very pleased to be joined by the CEO, Oliver Dura. They had their Capital Markets Day here in London, so we're very pleased to be joined on set. So I'd like to begin there with you, if we can, just in terms of where we are on that sort of dilemma. On the one hand, your order backlog is now at 6.5 billion euros, which is very, very elevated. Do you have the visibility to build out, as we're being warned we need to, the kind of defense industry in Europe that is required?
Well, absolutely. I mean, if we look at Mark Rutte's statement, I think a wartime mentality or wartime economy, that's what everybody is calling for. We have definitely ramped up. We are prepared as industry. I mean, looking at the radar production, we scaled it by 5 within the last 2.5 years. We put almost 1 billion of money into investments, half of that on R&D, capitalized R&D, 250 in supply chain, because we really raised our stocks to be able to deliver fast as Rutte calls for. And the rest is in infrastructure, really building a new plant for optronics, building a logistics center. So the key point now is definitely that we need the planning security from the politicians. I mean, there's a broad consensus, but they have to walk the talk in the sense of really giving a long-term perspective on spending.
And do you think that there is a sort of idea coalescing around what that would look like at the European level? Would, for example, a collective 500 billion euro fund, some of these things that are still abstract, how much visibility would that help give you in order as a sort of confidence to build out the kinds of volumes that they're talking about?
Well, our key focus today is, of course, on Germany, which is still our formative customer. So today we have roughly a dependency on 70%. So going forward, the intent is to internationalize Hensoldt. That means we're going to roughly 50% Germany, 30% Europe, and 20% rest of the world. So main focus on Germany. I think here you follow the discussion on a debt break, on an additional extraordinary budget. What we have to say today is definitely the still acting government made a change, made a step change. We had the extraordinary funding of 100 billion. We had also the recently announced industry strategy. So a lot of good intentions, I think. But going forward, it's really the question, will they release a debt break? Will we have another extraordinary budget? So I think there's a broad spectrum of solutions on that, but the consequence is still the lacking part of it.
Right, and you still need that planning security in the German context, as you described there, but also for these other customers that you want to serve. And looking at the details of your capital markets day, Oliver, and where your revenues come from, it seems that commitments from NATO countries are going to be crucial for you. Yes, of course, whether Europe is at war, whether there are hot wars going on in Europe matters, but it's the commitments from NATO countries, regardless of whether there is actually active conflict, that matters for your business.
No, absolutely. I mean, looking at NATO, and I would see broader the European market, we have the European Sky Shield initiative. I mean, Oliver said it rightly, we're the top seller of Hensoldt today is our medium-range air defense radar, which we have also sold to Ukraine. It's protecting the Ukrainian people at the moment. And here we see that this European Sky Shield initiative, more than 20 nations joined, but only 5 have placed their orders yet. Yeah, so I think that needs still to ramp up. And we also have to see with Europe, I mean, we see a strong call also, if you look at the security policy in Germany, a strong call for sovereign capabilities, while on the other hand, we have now a new EU commissioner who wants to have a European defense and coordination. Yeah, so I think that is still where we have a couple of question marks. But anyway, I think on the midterm perspective, also looking at the guidance that we confirmed yesterday, we even raised a little bit our revenue commitment and also book-to-bill. So in that regard, I think we're well prepared, but 2025 will be a decisive year.
Do you make the assumption that NATO countries will spend 2.5%, 3% of GDP on defense?
Our current planning is definitely based on 2%. I think that is what the discussion is about, where we see the consensus rising, and also looking at Germany till 2028. We have that commitment with the extraordinary budget. The point at the moment is, since the election of Trump, I hear that in Germany the discussion changed drastically, in the sense that now everybody, also Rutte, calls for 3% and even up to 3.5%. And I definitely think, I mean, with all the question marks on the how, that the commitment is there.
If European governments start placing the orders, and you've kind of outlined the fact that only a few of them are done so far when it comes to the Air Defence Pact, if the orders were placed, do you have the capability to deliver on those orders? You talked about the working capital you've invested into the business, which sounds significant. But do you have the capability, does Europe have the capability to deliver the orders were they to be placed? Or is Europe once again going to have to turn to the United States to deliver some of the capability?
Well, first of all, I can only speak for Hensoldt, and definitely we're prepared. I said it for the radars, same for optronics. We built a brand new plant to cope with that demand, so we did all the investments. We have quite a very good coverage on our supply chain, so that means...
supply chain's good, is it? That's solid?
That's solid. In that regards, I think we can respond. I would think that still the demand will progressively increase. So we're currently looking, can we build additional production lines, all of that. But a lot of that, I think, also depends on partnering. And if you just mentioned US, you heard that recently we signed an MOU with Lockheed Martin. So I think also with Germany buying heavily in the US, CH-47, F-35s, and also looking into the future, the F-127 Aegis systems. So there is a strong demand of localization as well. So I think in that regards, we're preparing to do double to answer the demand here, but also for other companies. That's part of our multi-domain solutions, the new setup we're choosing for Hensoldt. We will also be ready to produce third-party products in Germany.
And when a lot of money sort of rushes into an industry, particularly at a time when in Europe we're talking about basically creating European champions, not just national champions, certainly potentially at the defense level, where do you see consolidation happening in the defense industry? Obviously, you make sensors that go to a lot of different companies, potentially a target, but also you yourself looking at potential acquisitions.
Yeah. Key point for me in that regard, and I've said it a couple of times also in the media, I'm a big fan of having M&A being a means to an end. So I think a lot of the discussion that we see at the moment is about sheer size. Yeah, we think we want to have the size and so on. So I definitely think, and that's what also our North Star strategy is about, it's about differentiation. So I think Hensoldt is very strong prepared. We are delivering very well today, high-class products. And what you just referred to in your intro, I think we're now ready to pioneer software-defined defense, and that will make a difference. That gives us a strong position, and definitely we are self-confident that in this European consolidation, we will play an active role.
Okay. And as sort of the defense industry in Germany sort of rises, on the other hand, you have the auto industry that is falling very precipitously, a lot of layoffs. But I understand that you're also looking at the auto industry, its sort of talent pool, to build out your talent pool. Explain that to us a little bit.
Well, absolutely. So at the moment, as one of the, let's say, challenges in filling that demand, as you rightfully asked for, is the war for talent, is getting really the high-quality people, especially looking at pioneering software-defined defense. We need more software engineers. We really need the brains that are out there on the market. And here, the current struggle of the automotive is a pure chance for us. So we're currently in negotiations with 2 companies, automotive suppliers, where we are about to take full teams of up to 100 people into our teams there. And I think a great opportunity is also looking at filling this demand, that those people from automotive, they come from serious production. Yeah, despite that we get the workforce, we also get a lot of know-how in order to speed up. I mean, building our new plant, we work with Porsche Consulting, so they are the experts that really help us to scale in the way the demand is needed from the market.
We will watch that relationship closely. Oliver, thank you very much. Thank you for joining us. Oliver Dürer, the
Pleasure.
CEO
Thanks for
of the
having
German defense firm Hensoldt. And thank you to Bloomberg's Oliver Crook for joining us for that conversation. Coming up on the programme, thinking about Russia's impact, actions, influence in Europe takes us to our next conversation. Pro-EU protests in Georgia have entered a 3rd week, with the ruling party set to appoint a loyalist as the country's next president this weekend. We'll have the latest next. This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to the program, 8:45 here in London. Now, growing demand for IVF has turned the global fertility industry into a $35 billion business. But driving this trend are impoverished women who put themselves at risk by donating their eggs to earn money. Today's Big Take looks at how human eggs have become a premium commodity in a global market, giving rise to a largely unregulated and dangerous marketplace. We're joined now by Cindy Wang from Bloomberg's investigations team, who's been working on this story. Cindy, quite a disturbing read then, this story that takes account or gives us an account of a number of women involved in this trade. In what way have human eggs then become a global commodity?
Hi there. Yes, it's pretty remarkable, actually. With the booming fertility industry globally, it has turned the human's egg, especially it has turned the women's egg into a very precious commodity traded around the world. So our investigation unveils how the egg donors are recruited into this $35 billion and growing global market of assisted reproduction. This industry comprises would-be parents, donors, their agents, doctors, and fertility clinics. And many of the fertility clinics, they're actually backed by American private equity and Wall Street investment banks because they see this as very lucrative business. So we have talked to and interviewed several donors around the world. That includes a teenage girl in India. When her eggs were harvested at a fertility clinic in India, her government ID shows she was only 13. We've also talked to a model in Argentina and 2 egg donors from Taiwan. So people from these places have repeatedly traveled and evaded the U.S. immigration controls, trying to sell their eggs in the U.S. by the American fertility clinic. And many of the fertility clinics, they are aware of and sometimes even aided such illicit border crossing. We've also talked to the police in Greece, and the Greek police found out there are as many as 75 alleged theft of eggs that's taken from the IVF patients from a fertility clinic locally. And we've talked to a mother in Greece who was informed by police that half her eggs was actually stolen and used on another patient undergo the IVF treatment. And in China as well, even though the country bans buying donors' eggs, but obviously there is a big black market. Donors told us that in China there would be a van with darkened windows driving the donors to outside of the city to an unknown lab. And the lab from the outside would look like just a normal residence, but inside there are equipments, there are well-trained doctors to help these donors retrieve their eggs and complete the surgeries. So our story actually shows that the human egg trade thrives in the open markets, gray markets, black markets globally. And when there are opportunities, there is exploitation.
Cindy, incredible reporting. Fascinating read. Thank you very much indeed for bringing it to us. Bloomberg's Cindy Wang. You can read today's Big Take on the terminal. NI Big Take Go is the function. You can also find it in the latest edition of the Business Week magazine.
Let's return to the subject of geopolitics. Georgia's pro-European Union protests have entered their third week amid an intensifying police crackdown. The unrest was triggered by the ruling party's decision to halt talks on joining the EU and comes as it prepares to appoint a loyalist as the country's next president tomorrow. Bloomberg economy and government editor Greg Sullivan joins us now. Greg, thanks for bringing us the latest then. This has been something we've been watching the twists and turns of for many weeks now. Who is likely to be named president and what will happen in terms of the current president?
Well, it's almost certain that a current lawmaker and actually former footballer named Mikhail Kavalishvili will be named the next president. He's the nominee of the ruling Georgian Dream Party and has a history of anti-Western comments, as well as a career that saw him play a stint with Manchester City. Now, what's important here to note is that the current president, Salome Zorabashvili, she's been very pro-EU and has been very critical of the October parliamentary elections, even calling them a Russian special operation, and has urged the protesters to go out. She's vowed to remain the voice of the nation. Whether that's a rhetorical position or something more legal is probably yet to be seen after the election. But for now, we know that this will deepen the rift between the pro-European opposition, the protesters, and the ruling government, Georgian Dream Party, which is seen as far more pro-Russian. So in the aftermath, we can expect more protests. We'll have to keep an eye on that.
What is the longer-term trajectory for Georgia that comes out of this election?
Yes, you know, that's really the question here, and clearly what's at issue in both the election and the protests. The opposition has these NATO and EU ambitions, but the ruling Georgian Dream Party actually suspended EU membership talks until 2028. They've been kind of seen as closer to Russia, and so really this is about a battle for the direction of Georgia and in which way it could go. Right now, the ruling party seems to be pulling it back away from EU, or at least slowing down that process, even though EU ascension is in their constitution. But it will be interesting to see how it plays out in the years to come.
Fascinating weekend coming up in Georgia. Greg, thank you for setting us up for that weekend. Greg Sullivan joining us on the Georgian political story. Let's talk about the kind of the political shocks that we're watching around the world. You've obviously had a series of them in South Korea. We've got this instability in France that we're watching so carefully. We're awaiting an announcement on a new prime minister. We thought we were going to get it last night. We were told we were going to get it this morning. President Emmanuel Macron back from Poland, expected to make that announcement, hoping to forge a broader coalition that'll keep the next prime minister in place until the presidential elections in 2027. Obviously, that's when his term ends. Antonio Barroso joining us now on this story. Antonio, talk to us about what's at stake here. We still don't know who the next prime minister is going to be. We know the challenge, and that's basically to keep the government intact. What's at stake here?
Sure. I'm not surprised that it's taking Macron so long to decide. It's a tough choice because the new prime minister will have to contend with a continued fragmented and polarized parliament. And I think what's at stake here is the formation of some sort of loose pact of non-aggression between the centrist parties, the center-left Socialist Party, those parties on the center that support Macron, and then the Republicans on the right, so that they will commit not to vote in favor of dismissing the government. But that's just non-aggression, right? That doesn't allow really for the approval of policies. These parties have very different preferences when it comes to issues such as fiscal policy, such as pensions, such as migration. So even if you have a pact of non-aggression, getting policies passed in parliament is going to remain a huge challenge.
Okay, which suggests that it'll be difficult for anybody to get this done, Antonio. I mean, what are we going to be looking for? What will market participants be looking for when they see this name? What dots will they be linking to try and assess, well, will this person be any more likely to hold office as Prime Minister for longer than we saw with Michel Barnier?
Well, I think, it's difficult to know what kind of signs we'll be looking for in terms of the personalities because, yeah, personalities matter to a certain extent. You might be someone, who is right now being flagged potentially, François Bayrou, a centrist politician, might be able to build ad hoc coalitions to pass policies. But I think the same challenge remains. The problem, as I mentioned before, is that Parliament is extremely polarized and fragmented. So I think much more than the personalities, I think markets will look at or should look at what the Prime Minister is able to do. For example, will the new Prime Minister be able to get a budget for 2025 passed early next year? We know that a special law that allows the government to roll over the 2024 budget has been sent to Parliament. It's very likely that this law will be approved before the end of the year. But the challenge of approving a new budget for next year remains. And if the new Prime Minister is able to get a new budget passed in Parliament, I think that will be quite important.
We're watching for the news. We still don't know when we're going to get that news. We thought we were going to get it last night. We are anticipating it this morning. We thought we would be getting it maybe during this show. Now looks like that's not going to happen, and we're going to get it a little bit later. There's a co asking this morning, why is Macron prevaricating? Maybe he's struggling to get a name that fits all those bills. Antonio, thank you very much indeed. Antonio Barroso. That takes us into the weekend. Do we get an announcement this weekend? If we don't, there's plenty of other things that we can be diverting our attention to.
Absolutely. I think in Paris you can go ice skating. If you're fed up with all of the politics, then there is an enormous indoor ice skating rink being opened with a huge disco ball in the middle of it. What's not to love about that, Guy? That sounds like a brilliant place to go when you're waiting for political news to develop.
Yeah,
maybe you'll be watching the football.
Maybe, okay, yeah, or you could be dressing up as Santa. Santa Con is on this weekend. You've got to go in the full outfit, though.
You do, yes, I was reading the instructions. You can't just go in a Santa hat. You have to be in full Santa gear from top to toe. And it is a self-described, nonsensical Christmas parade. So, yeah, don't expect anything very
So I'm going to talk about the football. Anna's going to talk about the darts.
Oh, brilliant.
This is excellent. So, yeah, so it's the Manchester Derby this weekend, Manchester City versus Manchester United. What I'm still stunned about is that Manchester City is still 4th in the Premier League. Manchester United is 13th. Because City haven't won for ages, and yet they're still sitting there at 4th. And I think they're only 8 points behind Liverpool, though I think Liverpool have got a game in hand. They went down to Juve pretty hard this week. You can talk about the darts now.
I will talk about the darts, yes. Luke Littler. Does anyone remember him? He became something of a phenomenon. He was really very young when he did really very well in a recent darts championship. Well, he's going to be playing at the World Darts Championship. Some people will be actually watching the darts. Other people who will be there will be just dressed up in fancy dress costumes.
It's a big weekend for dressing up.
And drinking, because if you watch, if you see the pictures, or if you're anywhere in North London and you see the people who are attending, it's a spectacle.
Yeah, so you can either dress up as Santa or you can go to the darts this weekend.
That is the mission of the weekend.
Or you can watch the football. 4:30 on Sunday, I think the football is on.
Speaking of the weekend, be sure to catch Bloomberg's new weekend edition. We bring you a collection of interviews, ideas and stories that explore the fascinating places where finance, life and culture meet. That is it for the opening trade. Have a good weekend, everybody. This is Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Well, good morning, everyone, and welcome to The Post. I'm Francine Lacqua here in London. Now, China top leaders have set domestic consumption as their top economic priority for next year, trying to bolster confidence against the threat of looming U.S. tariff increases. Now, to talk about all of this, Daniele Antonucci, Chief Investment Officer at Quintet Private Bank, and Beata Manti, Citi's head of European Equity Strategy. So thank you both for joining us. I mean, it was a big week for China. Were they not? What kind of policy were we going to expect? I mean, now they want to boost consumption, but we don't really have more levers than the market was expecting. Are we going to see disappointment, Antonio?
That's right. I think so. I think the overall sense is that there is a degree of stimulus, there is a commitment to do more for the domestic economy, but by and large, we are lacking detail. Obviously, China added some spark to global markets a month or so ago, but at the same time, we haven't seen the strong stimulus of the fiscal type that would boost the real economy. We have no active positions on China at the moment. We have a long-term exposure to emerging markets across equities and also fixed income, but we are refraining from adding to China just yet.
Beata, are we a little bit in a wait-and-see mood, also given what Trump was saying about inviting Xi to the inauguration? I wasn't sure what that meant economically.
Nobody is sure about that yet, right? But I think everything we are hearing is a step in the right direction. We just need to hear a bit more details, right? So the news flow has been underwhelming. We didn't see, the market wants numbers. We didn't get the numbers. The view of our economists is that we could get the stimulus next year, the consumer-driven stimulus of 2.4 trillion yuan. Nothing has been mentioned so far about that, but this is our house view. So it's going to be gradual, more is coming, and I think it's one of the pieces of the puzzle that kind of underpins a bit better story for European equities that we've seen this year.
Daniela, what are you expecting actually from the Fed next week? I mean, a lot of the focus has been on inflation numbers and some of the other underlying figures that the Fed looks at.
So I think next week is easier. So we expect the Fed to cut rates.
Easier said than done, Daniela.
That's right. It is.
That always makes me nervous.
But the real question, I don't think, is next week as such. I think it's more further down the line. There's a strong market consensus that the red sweep that we got, the forthcoming fiscal stimulus, is likely to be positive for U.S. growth, and the tariffs negative for the rest of the world. But it's a lesser focus on whether these policies could be inflationary and longer time horizons. Actually, I think there's the risk that not next week, but early next year, the Fed will slow the pace of rate cuts. They might pause for longer than the markets think. And I also believe that there is a reason why the dollar is strong. We expect more rate cuts the side of the Atlantic with the ECB, potentially bigger rate cuts if the tariffs take a toll in Europe. So the Fed, I believe, another rate reduction, but on the hawkish side going into the new year.
Beata, and this was some of the things that we were, also suggesting, is that actually if you look at the expectations for a lot of central banks, including ECB, they're not really touching tariffs at the moment because they don't know what they'll be like.
Absolutely. We really don't know what we are playing against, but the view and our model suggests is that the market has started to play it full on, thinking that the blanket tariffs would happen, right? Our analysis that we've done with analysts across all different sectors suggests that the impact from the tariffs could be around 1 to 2 percentages of the EPS for next year, right? It's something, but it's not an absolute disaster. So with that in mind, we have below consensus EPS growth for next year. Instead of 8% that the analysts expect, we think we are going to continue to see some more downgrades coming through. We have 5%. That's conservative. And what I get for that EPS growth, with the assumption of only 5% re-rating to long-term averages, I get almost 10% upside for Stock 600. Some people say it's bullish, but it's really important to know where we are coming from, right? When you start thinking where we are going to.
Yeah, it's bullish, but also you have to take it as a whole. So we also heard from Christine Lagarde on this growth, momentum in Europe that will be quite tough. Here she is.
But the latest information suggests it is losing momentum. Surveys indicate that manufacturing is still contracting and growth in services is slowing. Firms are holding back their investment spending in the face of weak demand and a highly uncertain outlook. Exports are also weak, with some European industries finding it challenging to remain competitive.
I mean, this goes back to, how do you fix competitiveness in Europe, and how does that also translate into what stock picks you like?
Absolutely. So competitiveness issue is a long-term structural story, and we could talk about it for the entire program, right? But what Lagarde said tells us that they are really focused now on the slowdown in growth. That's important. That's a very different setup to what Daniela has mentioned about the US, when the Fed could do less because the economy is so strong for now, right? Now, in Europe, we don't have that problem. So the ECB is going to cut, according to city economists, at every single meeting until all the way till September. A few months ago, we thought it would only happen at every single quarter. And again, not a game changer, but this is one of the issues that could underpin equity markets into the next year. But of course, competitiveness and news flow from policymakers. I'll be really focused on what the new German government will have to say about that. Really to be watching out for.
Yeah, and we'll talk a bit more about politics. We're also waiting for this French Prime Minister announcement possibly coming soon. But then, I guess the bigger concern is also what happens to the dollar, and therefore what happens to other currencies, including the euro.
So here we have a near-term horizon. Like we said before, it's a strong dollar. You have a growth differential that's in favor of the US. Yeah. There's a degree of uncertainty when it comes to China. We talked about it before. The Eurozone as well. So we have a strong dollar. Yeah. Then in longer horizons, these very policies, it's not clear that they support the greenback. Of course, a wider fiscal deficit, will need to see how wide it's going to be. At these longer horizons, I would expect potentially some risks that the dollar gives back some of the gains we are seeing now and we are continuing to see for some time.
So what does it mean for your appetite for European assets?
So generally speaking, we reduced our exposure to European assets. We reduced our exposure, for example, to European equities. Yes, rate cuts, like in other markets, could be supportive, but I think they are by and large in the price. I don't see the catalyst when it comes to a pickup in the fundamentals. And with the situation in France, also in Germany, with the election ahead, I don't think there's a good chance to see a resolution, or at least the beginning of the resolution of these structural problems that have been there for such a long time.
Okay, thank you both. Daniele Antonucci from Quintet Private Bank, Beata Manti from Citi, both stay with us. Now coming up, who will be Emmanuel Macron's new prime minister? We take a look at his options to avoid another government collapse. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, the French President, Emmanuel Macron, is widely expected to announce a new prime minister in the coming hours. Now, Macron is aiming to forge a coalition that will last until 2027, until his term ends, and avoid another government collapse at the hands of a divided parliament. So let's get more from Bloomberg's Anya Nussbaum in Paris. Anya, so you've been following this from the very beginning. There's a lot at stake, but how difficult is it to find the right person at this juncture in time?
Morning, Francine. It's extremely difficult for Macron to find the right person because the next prime minister, whoever it is, will be facing the daunting task of finding a coalition in a deeply divided National Assembly that has been divided in 3 blocks since Macron called snap elections this summer. So right now, Macron is meeting with a longtime centrist ally. His name is François Bayrou. You can see him on this infographics. He has been working with him for years, and he's a man who both has shown some respect for Marine Le Pen and also willingness to find compromises. He will have the mandate, if he's picked by Macron, to build a coalition both with, probably with the socialists and with the right, which means granting huge concessions to both camps.
Yes, so the problem, of course, Anya, is that, we need to look at how the far-right rival, the leader, Marine Le Pen, is likely to react. But you now have a parliament that's split 3 ways. So finding, again, a candidate that can speak to all 3 is extremely challenging and difficult.
It seems almost impossible, actually. It's true that the previous Prime Minister, Michel Barnier, has tried to work with Marine Le Pen. He granted her key and expensive concessions on the 2025 budget. And yet she blew it. She decided to oust him to join a coalition that toppled him last week. So Macron is now facing the reality of not being able to work with the far right and having to work with other political parties, especially trying to rope in the most moderates of each party, including socialists, Greens, and the traditional conservatives. But these people hold very, very diverging views on anything and everything, from taxation to business to social justice. So it's going to be really difficult to work with everybody.
Thank you so much, Anya Nussbaum there in Paris. Of course, our political reporter who follows this very closely. I know she'll be up to date as soon as the name breaks, and we'll bring her on for expert analysis. Now, let's return to Daniele Antonucci from Quintet Private Bank and Citi's Beata Manti. So thank you both for staying with us. Beata, I mean, look, whoever takes over from the outgoing prime minister has a very big job. I mean, it's extremely difficult hurdles because of this fragmented parliament. What does it mean for French stocks and French assets?
Absolutely. So our view is that whoever is appointed is not going to be able to have a functioning government as such. So this political uncertainty that we've been seeing since June is going to continue. There is no change. Now, when it comes to CAC 40 and French equities, these have been the biggest underperformers year to date within the European space. Everything has started with political uncertainty, but then I would argue that a big influence on these huge downgrades that French EPS has seen has been due to the weakness in China, right? CAC 40 is such an international index. It has more exposure to the US than it has to domestic French. So the market has been very worried about all the uncertainties. Of course, tax hikes in the previous budget were not helpful, but we argue it's mostly in the price now. And looking forward into the next year, a lot has been in the price. Uncertainty continues. It's priced in. So I think investors should start looking on the dollar international side of things. Perhaps luxury goods are not as exposed to tariffs. They would pass the costs through. So bottom line is, very recently, 2-3 weeks ago, we've actually, from being much more cautious on France, the moment French election has happened, we've moved it in our European country portfolio all the way to overweight because of these reasons.
Interesting. And Daniele, how do you look at, I mean, you actually like some European bonds, right?
I do.
Is France one of them?
Not quite, no. But I would say, just like in equities, obviously spreads have widened quite a bit, so the same rationale could apply. Valuations are more attractive right now. But generally, I don't think I would look at France as a top pick going into 25. Generally speaking, I would like to buy, and I have bought short-dated government bonds. Yield curves are flat, so there's no reason to move along the curve. We have an overweight on European investment-grade bonds, but even that, spreads are tight. We have reduced that, and we have reallocated to these government bonds. Generally speaking, I don't think I would want to reduce our exposure to European equities, of which France is such a big part, to underweight, but I wouldn't add at the same time. We're neutral at the moment.
What do you do with Germany? Again, big election in February, many implications for the rest of Europe.
It's a rather similar rationale, and I think that uncertainty that we have seen hasn't played out fully. So another thing that we did, our investment philosophy combines growth but also wealth preservation. We bought an instrument that appreciates when European equities go down. You should think like an insurance. It's just in case. The best scenario is that you don't have to use it, but if that happens, if there is additional downside risks, the market's price in European equities, that position will benefit and will protect portfolios.
I mean, there hasn't been great news out there in general. I have to say I was looking also at GDP in the UK, worse than expected. We're seeing a contraction. And so, again, that puts a lot of questions about the Labour plan.
Absolutely. So overall, broad-based Europe, the news flow has been quite depressing over quite some time. But our argument is that this news flow has been already priced in. And you could expect some actions, some catalysts coming through that could reverse it, not to super positive outlook, but you will be able to see positive deltas. And from this level of bearishness for European markets, where everybody is bearish, it's very interesting what Daniela mentioned, that they are no longer underweight, they are neutral. That's the first step. There are many investors that are still underweight, and they are realizing that they are risks to the upside that could put their portfolios at risk. So that's the first step of capitulation of bearishness, closing these underweights, moving to neutral. But for investors to really start thinking, do I actively buy Europe? You need to see more positive news flow, certain types of catalysts. We also talk about ceasefire in Ukraine as underpinning cheaper energy prices for very energy-intensive industrial base in Europe. I could talk for a very long time about possible catalysts that most likely will happen at the same time, or more or less at the same time, making the entire puzzle together. Not big bazookas, but the bearishness now is good, right? Yeah. That's the foundation for the catalyst to start working.
Thank you both for joining us. That was, of course, Beata Manthi from Citi and Daniele Antonucci from Quintet. Coming up, we have plenty more, of course, on markets. We'll have plenty more on geopolitics. And we look ahead to the Fed next week. This is Bloomberg.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. Well, low productivity and failure to invest have led to vast amounts of lost growth in the EU. Now, with France and Germany in political crisis, the continent risks more lost years of stagnation, as our weekly doc explains.
The news for Europe just keeps getting worse.
The French government collapses, plunging EU's second largest economy into turmoil.
France's political upheaval in December offered another glimpse at fractious European affairs.
Germany's under pressure, and Volkswagen workers are striking hard.
In my view, we are already in a crisis mode.
Our former model is over. If we follow our classical agenda, we will be out of the market, I have no doubt.
The EU's economy is now fighting for survival and struggling to keep pace with the US and China.
Had the European economy grown as fast as the American economy over the past couple of decades, we'd be generating 3 trillion euros of extra income every year.
That's roughly the equivalent to the total GDP of France being routinely added into the economy.
Europe needs to have a digital era economy with companies that challenge those from China and from the US.
Without that, the region's at risk of being unable to afford to protect itself in a world where security is no longer guaranteed.
It's just a very tense moment for the world, and Europe's at the center of it.
And you can watch this week's documentary from Bloomberg Originals in full on YouTube and on our website. Now, the picture is looking very interesting in terms of what we're looking out for. In the U.S. futures seeing a little bit of a lift. Tech stocks probably leading a lot of these futures at the open. And then we look ahead to some of the other figures, data for the final Federal Reserve interest rate decision of the year. That's next week. Coming up, a second martial law impeachment vote looms for South Korean president. We're live in Seoul, where protesters have gathered again.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change, In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China's key economic conference disappoint investors. Beijing signals more borrowing and spending, but leaves out policy details. French President Emmanuel Macron is set to name a new prime minister in the coming hours as he looks to avoid another government collapse. Plus, Britain's economy unexpectedly shrinks for a second straight month in October, extending a disappointing run of growth figures under the new government. So the South Korean President Yoon Suk-yeol is set to face a second impeachment vote on Saturday after his declaration of martial law last week. Now, his approval rate has now slumped to its lowest level, just 11% since he took office. Bloomberg's Sherry Ann joins us live from Seoul. Sherry, thank you so much for joining us. I know you're in the middle of Seoul. There's many, many protesters around you. What's the latest on the political standoff in South Korea?
Francine, so far it feels almost like business as usual. I'm in Gwamun in Seoul, and you can see that behind me there are some holiday decorations. Further behind me there's actually a holiday market where people are going to enjoy the sights. And yet you can feel the political tension looming over the city. Just to my right, you can see police vans standing here. They'll be here all night. Earlier in the day, there were protesters on the other side of the road, and those are President Yoon's supporters. They're against impeachment. I talked to the organizer of those protests who said they'll be back again tomorrow to demand that President Yoon stay in office. They think that the opposition was the one that first created the crisis. Of course, as you said, his approval rating has fallen to a record low. In fact, Gallup Korea now saying that 3/4 of respondents want him to actually be impeached. And in the impeachment vote tomorrow, that could potentially happen. More ruling lawmakers are now hinting that they will vote for impeachment. If that impeachment bill goes through, then that goes to the Constitutional Court, and we could see a few months later also an election being held.
So how is the government running right now, Sherry Ann?
Authorities have been out in force in the last few days. We have heard from ministers and also finance officials. Today, I spoke to the government spokesperson and culture minister, Yoo In-cheon, who was reassuring the public, reassuring foreign visitors, also that he was talking to foreign government officials that everything is fine, stable, and secure to visit South Korea, although he did say that he was shocked at the declaration of martial law, not to mention that, of course, he wanted to see some stability in the country, although he was encouraged by the strength of democracy. We also heard from the finance minister, who is saying that they will do whatever they can to support the economy. He already talked to major credit ratings agencies, not to mention foreign companies today, to assure them that institutions are running normally right now.
Sherry-Ann, thank you so much. We'll, of course, go to Sherry-Ann throughout the day and the evening to see exactly what's going on in Seoul. Now, Broadcom shares rallying in U.S. pre-market after predicting a boom in demand for its artificial intelligence chips. Now, the company, a chip supplier for Apple, says sales of AI products will gain 65% in the first fiscal quarter. You can see Broadcom pre-market gaining some 14.5%. So let's bring in Jimmy Muchachetre, the senior equity analyst at Investec. Jimmy, so good to speak to you. I mean, look, you're a medical doctor, so I'm going to speak to you about healthcare, but you also look at AI, at crypto, and Broadcom up 15% pre-market, and this is really on everything to do with chips, on the fact that we're just expecting this AI boom to continue.
Yes, 100%. So Broadcom has done a remarkable job of segregating its business between hardware and software, and is benefiting from both sides. So as you see some of the big hyperscalers looking to create their own custom chips away from NVIDIA, that benefits Broadcom because it supplies all of them, whether it's Meta, Apple, Amazon, or Google by itself.
But Jimmy, is there an infinite demand for some of these chips in terms of higher value chain, or are we going to see the U.S. really flood with a lot of them, you know, when they catch up, and then it's a little bit like the mining sector. At some point, there's just too much of it.
I think that's right. I think we have to keep grounded and remember that the semi-cycle is a very, very cyclical sector. At some point, there will be over capacity. Yeah. The market will need time to digest, and we'll see a cycle coming out of the semiconductor market.
Jimmy, what do you spend most of your time trying to understand? I know we talk about tariffs and trades, and there's, you know, equity valuations, but is there something that the market is mismanaging? Are they pricing in too good news for the U.S. and too bad news for the rest of the world?
We spend a lot of our time looking at trends and where is the puck going to be, and we try and skate to that point in time. I mean, in the short term, I think you're right. All the momentum is with the U.S. It is hard to look past the U.S. at present. I mean, you just mentioned the UK GDP numbers, which disappointed for a second month running. You know, I know these are monthly numbers. They're volatile, subject to revision, but it's not really a good trend. You look at Germany, France, there's no leadership in the EU, political debt crisis in France. So it just leaves the U.S. as one area right now where there is political certainty, there is the legislature is locked down. We know exactly who's in charge. We know exactly what they want to try and achieve. So that bit of certainty is what is driving the U.S. market.
But, Jimmy, I guess the concern is that is U.S. equities priced to perfection, and actually has all of the good news already been taken into account by the markets?
Yes, 100%. I think in the short term, valuation is less of a concern. Valuation is a concern in the long term. So the momentum could continue to carry us through. I mean, I think we see a Santa rally for sure, given where we are in the year, and perhaps, you know, the first few weeks of the new year. But then what happens after that depends on a lot of what the Trump administration does. You know, we talk about the 3 S's: the scale, the scope, and the sequencing of Trump's policies. And we think that's what's going to determine what actually the market focuses on when you come to the first half of next year.
We talk a lot about, of course, decentralized finance and the fact that there's now a crypto czar in the White House. Yes. Is that going to lead to automatic higher Bitcoin? It's at 100,000. Or are we going to take a pause as we understand exactly where it goes?
There is a case to be made for Bitcoin reaching 150,000, for Solana reaching 7,500, for Ethereum reaching 7,500, Solana reaching 750. The biggest headwind for Bitcoin was regulatory, right. And that has been taken away with the Trump presidency, with Paul Atkins being appointed in this new role of crypto czar. So that has been the biggest headwind. So if you take that away, and then you add in all the other tailwinds, you know, for example, you've got the FIT 21 legislation, which is passed through the House, is now in the Senate, and it passed through the House with flying colors, support bipartisan. So we expect that to pass through. If that does pass through, it's going to create a very strong legal framework in terms of the guardrails, what falls under the SEC remit, what falls under CFTC remit, and that is all going to drive, that is likely to drive institutional adoption.
But Jimmy, does this help with crypto ETFs? Does it help with Bitcoin, or is it a fundamental change of the financial system?
We think it's all of those things. We think Bitcoin is the poster child. We like to think of it as like the snowplow. You know, the snowplow that goes in front and clears the way for everything else. Yes, we're already starting to see Bitcoin ETFs flows coming in, and we think that's going to continue. Yeah. If we get FIT 21 passed, that's going to be another fillip to that. We're starting to see IPOs. I think earlier this week we got Crypto Check in Japan, and we expect Avant-Garde to follow suit, Circle to follow suit, Kraken to follow suit. All those are IPOs for 2025, and once that happens, we're going to see institutional adoption. Right. Then the other thing we're seeing is a lot of investors are lobbying corporates to buy Bitcoin as part of their balance sheet. We saw Microsoft rejected that idea, but we've got Amazon shareholders saying you should spend 5% of your 85 billion in cash into Bitcoin. Yeah. So if those dominoes fall, we see a lot of other institutions follow.
Jimmy, you're a certified doctor, medical doctor, so you understand, the healthcare system. What are we seeing in the U.S.? There's concern from, many people about an anti-vaxxer that's, possibly in the White House. Does it change the dynamics for pricing? Does it change everything?
It matters a lot. It won't change everything per se, because what we do is we focus on companies that are not hampered by regulation. So if you've got good innovation, if you've got strong patents, if you've got strong cash flows, are you in a niche area, do you produce free cash flow, returns on invested capital, those kind of things. So yes, an austere regulatory environment will be a speed bump, but those kind of companies will continue to do well. I'm talking about companies such as Eli Lilly, Novo Nordisk, AstraZeneca, Boston Scientific, Intuitive Surgical. These companies will do well regardless of who is, the HHS secretary. But for the healthcare sector as a whole, yes, there is no getting away with this is not really good. We saw 70-odd Nobel laureates writing an open letter and signing it.
This was a big deal. It was a big moment in history.
Yes, 100%. And it's not just the HH secretary, RFK Jr., it's Dr. Mehmet Oz, it's the new incoming Dr. McMurray, the FDA chairman. So the only person we think is not an anti-vaxxer, anti-establishment is probably the Surgeon General, but everyone else is, going to be fighting against the healthcare sector. So we would not be overweight the sector going into 2025.
That seems fair. Jimmy, thank you so much for joining us. Please don't be a stranger. I hope this is like a regular interview. Jimmy Muchachetere, their senior equity analyst at Investec. Coming up, pro-EU protests in Georgia have entered a third week, with the ruling party set to appoint a loyalist as the country's next president this weekend. We'll have the latest next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, there are fears that the political crisis in Georgia could deepen over the weekend as the ruling party prepares to appoint a loyalist president, despite weeks of protests. Now, the country has been in upheaval since parliamentary elections in late October. The pro-EU opposition, supported by the current president, Salome Zurabishvili, accused Russia of influencing the vote. Now, we spoke to her early last week about the protesters' anger.
They don't want to have a government that they consider to have been not with the approval of the majority of the people elected, decide without mandate to cut our ties with the European Union and throw the country into the arms of Russia.
Now, for more, let's bring in Bloomberg's Greg Sullivan, who's following the situation closely for us. Greg, hello. So who's likely to be named president, and what will happen to the current president?
Well, the Georgian ruling party's nominee is a man named Mikhail Kavashvili, and he is actually a former football player who did stints with Manchester City before entering politics. As a politician, he's currently a member of the ruling party and has distinguished himself with criticism of the West throughout his tenure. Now, what's interesting here in this particular election is that he's basically vying to replace the current president, who, as we heard, is very pro-European and has encouraged the protesters. Now, on Saturday, the process will be done by an electoral college. All members of parliament are part of that, so it is very likely that he will ascend or be positioned to be inaugurated later this month.
So what are the broader implications for Georgia's path coming out of the election?
Well, here and actually for the protests that have been happening for weeks after the October parliamentary elections, the key issue is in which direction will Georgia go? Will it realize its NATO and EU ambitions, or will it move closer towards Russia? Now, the ruling party, after winning the October parliamentary elections, did suspend membership talks to the EU until 2028. That breathed new life into protesters who are very worried that Georgia is moving away from their European Union ambitions. The ruling party has blamed a lot of the violence on foreign actors and what they called their chiefs. That's a sentiment that's been echoed by Moscow, but Moscow has largely said this is an internal Georgian affair, whereas the EU and the US have been very critical as Georgia seems to pull away from their EU path.
Greg, thanks so much. Greg Sullivan with the very latest, of course, on Georgia. Now, Russia is close to an agreement with Syria's new leadership to maintain 2 vital military bases in the Middle East state. Now, sources tell us that the Russian Defense Ministry believes it has an informal understanding with the Islamist group known as HTS. Now, Western officials are said to believe that the Russian bases could act as the deterrent to extremism in Syria. Coming up, we take a closer look at the burgeoning global trade in human eggs and its dark side among some of the world's poorest people. That's next, and this is Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
So our mandate is price stability, and we really want to have inflation in this target range for the inflation. And by lowering interest rates today, we have stabilized the inflation forecast, which also means that the probability of future cuts or cuts below zero are lower today than they were before.
You also said in your statement you changed your language, while in September you said that further rate cuts may become necessary. Now you're just saying that you'll maintain a monetary policy which is necessary to ensure inflation remains in the range of price stability. So is it correct to understand from that we will see less rate cuts in the future?
So with this rate cut that we did today, monetary conditions are appropriate again, and the next decision will take place in March. Then we will come together as a board and take a decision if we need to adjust monetary policy to maintain price stability.
That was the S&P President, Martin Schlegel. Now, Donald Trump's economic advisors have told Bloomberg they're considering doubling the U.S. state and local tax deduction known as SALT. Now, economist Stephen Moore, a member of President-elect's transition team, says the tax break could go from $10,000 to $20,000. Now, the deduction is popular in high-tax states like New York and California, but is expensive to maintain. Let's also turn to today's Big Take. It's an in-depth investigation into India's growing role in the $35 billion fertility industry. But driving that trend are impoverished women desperate to survive. Our team at Bloomberg Originals have been taking a look at the true cost of a human egg.
All my husband does is get drunk and sleep. My kids and I won't be able to eat. We've also considered killing ourselves. Sumathi took me to a clinic in Vadalur. I was too weak to donate enough blood, so I said eggs.
The Dalits are among the most marginalized groups within the Indian caste system, often deprived of quality education and jobs.
All of us women are sanitary workers. I'll get 450 rupees a day. 100 rupees go toward our food.
But these women carry something more valuable than anything among their family's modest possessions: their fertility. It's an open secret that she is the fertility agent. She's a cog in a sprawling network of agents and go-betweens across the country, profiting from the sale of human eggs. Every 15 seconds or so, human eggs are taken from a woman somewhere on the planet to satisfy the global demand for assisted reproduction. Advocates warn that India's poorest women are at the mercy of an industry that preys on the most vulnerable. For Sumati and the other women in her village, the people who make the laws feel worlds away.
Sometimes we do regret donating ovarian eggs out of haste for the sake of debt relief.
Well, that video is part of a global multimedia investigation by Bloomberg reporters into exploitation and opportunity in the human egg trade, and it's the focus of this week's Big Take. Now, the story crosses the world from India to Argentina, Greece, and Taiwan. I'm now joined by Cindy Wang, Deputy Bureau Chief in Taipei. Cindy, in what way has a human egg become a global commodity?
Hi there, it's pretty remarkable. The booming fertility industry around the world has turned human eggs into a very precious commodity traded around the world. Our investigation try to find out how egg donors are recruited into this 35 billion and growing global market of assisted reproduction. This industry comprises would-be parents, donors, agents, doctors, and fertility clinics. Many of the fertility clinics are actually backed by or controlled by Wall Street investment banks or the private equities because they see this as a lucrative business. And the demand for human eggs are expected to only go up because more and more women are trying to have babies when they are older. And as women age, the number and quality of their eggs would decline. So that means the demand for fertility treatments and human eggs would be increasing sharply. And so our investigation piece reveals that the human egg trade operates in an open, gray, and black markets globally, and it's virtually in around regulated and unmonitored marketplace. Because usually when rules and conditions change in one country, the industry will shift to another. For example, in China, when parents are allowed to have more than one child, but they are forbidden to buy other women's eggs, these parents would normally look elsewhere for help. So usually they would go to US to seek fertility treatments or try to buy donors' eggs. So these human egg trade really thrives globally in open, gray, and black markets.
Cindy, I mean, this was a massive investigation, a real team effort across the world. What other abuses have cropped up?
Yes, in this investigation piece, we followed and interviewed several egg donors around the world. In India, we talked to a girl who, when her eggs were harvested at the fertility clinic in India, her ID shows she was only 13. She was lured into selling her eggs for under $200 US because all she wanted to buy is just a mobile phone. In Greece, we talked to a mother who was informed by police that when she was an IVF patient, half of her eggs were actually stolen and used to help other women to have babies. And it turns out that she is not alone. The Greek police had detected as many as 75 cases of alleged theft of eggs taken from the IVF patients at the clinic without the patient's consent. And in China, our donors told us that even though this country bans from buying other women's eggs, the donors would actually be driven in a van with darkened windows to an unknown lab outside of big cities, where the lab would look like just normal residents, but inside there are equipment and well-trained doctors to help with egg retrieval surgeries. So there are abuses everywhere.
Thank you so much. What an incredible piece of journalism, Cindy Wang. You can read today's Big Take on the terminal at NI Big Take Go on the latest edition of the Business Week magazine. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Back on the table, President-elect Trump's advisors mull doubling the state and local tax deductions. And an AI boost, Broadcom's rosy outlook on chips sends the shares soaring after hours. Good morning to you. We're eking out a little bit of a gains. We turned around in the past hour, up a third of 1% on the S&P 500. We are seeing inflows. The Bank of America flow show comes through. 10th week of inflows into the United States of America equity market at $13 billion. That is a record annually. I can tell you, though, for the 9th day in a row, more constituents fell rather than rallied. That is the longest shift in breadth, lower since 2001. So equities are on the up this morning. Roll it over, have a look at the bond market, because what you've got here is volatility at a 3-year low. Yields are up at 2 basis points. When you go to the very long end, there was a $22 billion issuance of 30-year paper, and I like what BMO had to say. There was no desire to pay up. The market did not want to dance with duration. What did we learn from those bond auctions this week? We'll dissect that in just a moment. Let's go back to Broadcom, which is surging in the pre-market. That's after the chip supplier predicted a boom in demand for its AI chips. We'll have more of the story a little bit later in the hour. Also keeping an eye on ORH after the furniture retailer raised its 2025 revenue forecast and swung to profit in the third quarter. Warner Brothers Discovery falling after announcing it's reorganizing into 2 divisions. One focused on streaming and studios, and the other on cable TV. Divide and conquer, they say. In just a few moments, we'll catch up with Luke Barr of Goldman Sachs Asset Management. A little bit later in the hour, Jose Torres of Interactive Brokers and Maureen O'Connor of Wells Fargo on the credit outlook for 2025. So we're inching back into the green this morning. Rounding out a week where, well, you just think of the year, 27% rally so far this year. Goldman Sachs' David Kostin looks ahead to next year, predicting another 7% increase in the next 12 months.
The stock market is pricing as though the underlying economic growth is closer to 5%. The economy, of course, is not growing as rapidly as that, but the performance of cyclical stocks relative to defensive stocks is more consistent with a pretty robust economic underlying activity. In fact, that is what most of the fund managers are anticipating. The animal spirits have really been out in force in the last month.
Well, let's get to the same house, different division. Luke Bars is the head of fundamental equity client portfolio over at Goldman Sachs. Luke, good to see you this morning. Listening to your colleague there, this market's trading like it's a 5% growth. It really is rolling higher. Do you get any sense that we're in some kind of an overextension here? I was talking about breadth a little bit earlier. The 9th day in a row when more constituents fell versus a rally. That is the longest run since 2001.
Well, good morning, Manus. And I think first and foremost, what is playing out in markets today is this optimism around some continuation of reform, but frankly, still a very strong, robust, underlying US economic growth outlook. What I would say, to your point around diversification and around the broadening out of that growth story, is that's actually fairly healthy. We're seeing a market that's focusing on fundamentals, that's looking at how individual businesses are performing and rewarding them accordingly. We do have some caution around valuations in parts of the larger cap space. We need to be thoughtful around that. But holistically, we still see opportunity across the US marketplace. And if you're selective and can find those winners within that complex, that for us is a healthy place to be.
Let's just talk about that broadening, because this is what you say. You expect the return structure of the stock market to broaden in 2025 against a backdrop of easing cycles and resilient growth. High valuations in some areas provide motivation for diversification. Where would you, I mean, look, maybe it's an obvious question. Where is the highest valuation at all? And I'm sort of thinking of the Mag 7 trading on a 41 projected earnings. Is that toppy? Is that lofty?
Look, it's a little bit rich, I think, in some of those areas. Again, you have to be selective around the individual business. And let's not lose sight of the fact that the fundamentals for a number of those still look very healthy. But if you were to look at it from the perspective of where are we finding opportunity, where you're getting attractive and discounted entry point, I would really say go down the cap spectrum into the US smaller cap space, much greater leverage into the continued strong growth domestically, as well as the benefit of reduced rates coming through in the US, which, whilst the Fed might be slightly slower than maybe people were expecting earlier in the year, we're still going to see a normalization of rates, and that does feed through into better margins for your small cap space, given these are more leveraged and often floating rate debt users. And so that for us is an area where this broadening story, that pull through of growth into the smaller cap space, given the underperformance you've seen for much of the last 3 to 5 years, is a very compelling starting point.
Luke, how much of that broadening into the small caps is predicated on another, at least, let's say, 80 to 100 basis points of cuts from the Federal Reserve?
Look, I think the market can adjust fairly quickly to expectations around the Fed. So I would actually say a fair amount of that is priced in. And so if we were to see a further slowdown in Fed policy, that might be something we just need to be cautious on. But at this point, look, our expectation is the Fed will move next week, 25 basis points, and then we likely have another 50 basis points in the first half of next year. But then from that point, I actually think the Fed can stay on pause, see what the inflation environment is like, and actually benefit from that underlying strength in growth and fundamentals. And so that environment, even if it's only 75 basis points from here forwards over the next 12 months, still is very healthy for that smaller cap part of the overall US equity landscape.
Well, it is about the trajectory, isn't it? I mean, if we get that, that's 175 basis points, and that's almost as much as we got during some of the more critical moments in markets. Overnight, or over the past 24 hours, we're talking about maybe doubling the SALT limit here in the United States of America. There's a debate about the sequencing of what happens in Congress, whether they go for one bill, all encapsulating, which is tax and immigration, or they split it in two. How important is it for the earnings per share metric, for the growth in equities, that these tax cuts, these corporate tax cuts, come through early and hard?
I actually think whilst that will be beneficiary to equity markets, clearly you're going to see an improvement in earnings and fundamentals. I don't think it's critical. I think the key driver here is a continuation of US growth in the 2 to 3% range, and actually the continuation of reform, even if it doesn't come first part of the year, if we see that through the latter part of the year, that will be incrementally positive for the US asset class. And I think when we look at that versus other parts of the world, again, we do see opportunity internationally, but we are seeing a much more progressive reform agenda coming through in the US. And within that, we're seeing a stronger growth dynamic. And so, again, thinking about the broadening out of opportunity, it does exist internationally, but there is this reform agenda that is driving things forwards in the US, independent of whether that comes 1st of January or slightly later in the year.
We're going to spend a little bit of time on Broadcom as we go through this show. I think it's the personification of how you can read explosion and propulsion in AI relative to the rest of the semi industry. But you see particular opportunities in the enablers, that, you know, the semiconductors and that area. Is that part of this diversification story for you?
Well, I think it is at the margin. Now, what we have to recognize is for the last 18 months, the way to have played the AI trade and what is reflected in valuations in some of these major players is the semis and hardware trade. And so that GPU part of the ecosystem, where you very much have this demand-supply imbalance as people try to build out their large language models, has meant that you've seen very strong performance. We don't think that is necessarily culminating. We think there's opportunity going forwards, but the valuation that you're being asked to pay for some of those is just a pause for thought. What we would say is, as you break down the opportunity within the hardware side of things, the enablers, as you say, it's the transition from your GPU semis into your ASIC semis. So as you start to develop those models, as they go into operational development and actually start to be utilized, then it's about inference, it's about operational efficiency within your server businesses. And there's some great ASICs semi trades that just aren't necessarily priced in the same capacity because you haven't seen that pull through in earnings in the same magnitude as you might have seen in the GPU space at this point.
Luke, thank you very much. Succinct for Friday. We're back in the green. Let's see how long that lasts. Luke Bars of Goldman Sachs Asset Management. Other stories trending on your Bloomberg terminal this Friday morning. This is what we got for you. Chinese yields hit a record low. That's after officials vowed to cut policy rates, as well as banks' reserve ratios to help boost the flagging economy. On top of the easing bets, bonds also supported by concerns over a potential trade war with the United States. The UK economy contracted for a second straight month, leaving the Labour government's pledge to boost growth in trouble only months after taking power. Consumer services output tumbled 0.6%, including a 2% decline in pubs and restaurants. It suggests the households tightened their belts, possibly fearing a squeeze from the budget. Elon Musk renewed his long-standing feud with the SEC by posting a letter on X that said the agency is investigating Neuralink. The letter said the agency gave Musk a 48-hour window deadline to accept a settlement over the probe or face an enforcement action. The SEC declined to comment. Coming up, double deductions. President-elect Trump's transition team floats raising SALT write-off. More on the tax story next on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are. And we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack.
President-elect Trump speaking yesterday at the New York Stock Exchange. His team now mulling doubling the state and local tax deduction from $10,000 to $20,000. Joining me now is Anne-Marie Horder. Anne-Marie, look, this was much talked about on the campaign trail, the SALT tax. The question I have in my mind, it's such a political move, but where's he going to aim this at? It's not going to be uncapped. It is going to be capped, we understand. Does he have the votes to do this?
So what the Trump advisory economic team is saying is that potentially they can bring the cap up to $20,000. The issue they're going to have is the very slim majority in the House of Representatives. For Republicans, this is the slimmest majority they've ever had. It's only the second slimmest ever for the House of Representatives, which basically means every lawmaker then becomes king of the hill and can say, I'm not going to vote on any package unless it has XYZ in it. So what you have here is someone like Congressman Lawler, someone like Congressman Nick Lolita, these individuals from New York saying, you know what, maybe $20,000 isn't enough and the cap needs to be higher, which is why when it comes to the tax bill, it's going to be so complicated for every single Republican to agree on, because we're just talking about Republicans in New York. This is really going to benefit blue states with high taxes, New York, New Jersey, California. But if you're a Republican sitting in the Midwest, you don't want to see the tax break go up, period, for those blue states, let alone the Trump campaign team saying we're willing to go to $20,000. Do you see how difficult these conversations can start to get?
And as you say, it is razor thin in Congress. And will the Democrats be wholly united against raising it?
Well, the problem is that it's going to be attached to a slew of other tax cuts that Democrats are going to be against, like potentially a 15% corporate tax rate. Now, even though we heard there from President-elect Trump speaking yesterday at the New York Stock Exchange, talking about the fact that that's only if you make your products here in the United States. The fact of the matter is there's going to be a ton of tax breaks likely in there that Democrats are not going to line up for. So every single Republican will need to say yes on these bills.
And as you said, many new kingmakers. Everybody's emboldened. Now, one leader which is emboldened is, of course, Canada. We're seeing a real shift in the game, I would say here. They're considering, and this is their most radical or their end game, is where they would raise tariffs on uranium, oil and potash. But you've got Ontario, Doug Ford threatening to cut off the electricity flow to, I know this is saber rattling, cutting off the electricity flow to Michigan and to New York. But this is a shift in rhetoric and a shift in game theory.
Of course, they're looking at potentially the gambit of all the retaliatory measures they could take if they had to. And also a lot of this is likely just rhetoric because they're in the middle of this sort of negotiation. But this rhetoric, especially when it comes to what's going on in commodities, is very important. Oil from Canada, #1 importer. Uranium, incredibly important, especially in the Midwest, coming from Canada. So they're looking at these options. What they are going to do, though, potentially first, is more of the carrot approach, less the stick, which is to put money at the border and say, we heard you loud and clear, Donald Trump. We are going to try to put money at the border so that there's less drugs coming to the United States from Canada, and also to clamp down on some of the illegal migration flows from Canada into the United States. And then the harsher measures will be some of these retaliatory measures. I don't think it's going to come to this. This is all a negotiation at this moment.
Well, let's see whether oil gets a carve out, you know, for starters on the block. It's day 2 of billionaire and tech joining in on the inauguration. Let's just listen to Jeff Bezos.
I'm actually very optimistic this time around that we're going to see. I'm very hopeful about this. He seems to have a lot of energy around reducing regulation. And my point of view, if I can help him do that, I'm going to help him.
And that was Jeff Bezos speaking at the New York Times Deal Book Summit just a couple of days ago. Meta donated $1 million. Here's Jeff Bezos, $1 million coming from him. And as a kicker, he's going to actually stream the inauguration.
He's going to stream the
It's
inauguration.
brilliant, isn't it?
So what's interesting is these are just the companies we've heard about.
Right.
Obviously, there is going to be a slew of companies that are lining up, potentially as an olive branch, donating $1 million, which for them really isn't a lot, but it's the notion and this idea that, look, we're giving to your inaugural committee, we are ready and willing to work with this incoming administration. And we've seen that across the board. Meta, Amazon, GM's Mary Barra talking to Axios saying there's actually a lot of synergies between us and the Trump administration. We can work with them. This was someone who worked very closely with the Biden administration. I think a lot of these CEOs have seen how powerful it is if you were in a place like Elon Musk and that bet Musk made on Trump and now his proximity to power.
Well, it's, you know, the smell of power. The other billionaires, tech billionaires, see the advantage, and they want to be seated at that table for any negotiation as well. They want their share of voice. Anne-Marie, good to see you this morning. We'll see you a little bit later on, you and the team on surveillance. Anne-Marie Hordown. Coming up, it is a boom for Broadcom. The shares extend their gains on AI optimism. We'll give you the details in just a moment on Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but you can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, anywhere.
Go.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Cranny in New York. Let's get you up to speed with the front pages. What's making news around the world? Kick it off with the Associated Press. President Emmanuel Macron is expected to name his new prime minister today. Now, whoever is named will be the sixth prime minister from Macron's presidency. The new premier faces an immediate challenge in thrashing out a budget that they can pass through Parliament. Telegraph, it leads with Luigi Mangione. The suspect charged with the killing of the United Healthcare CEO Brian Thompson wasn't a customer. It dispels the idea that the alleged shooting was motivated by a grievance from his personal experience with the company. A senior police official says it may have been targeted because of its size and influence. And on Bloomberg.com, this is what we lead with. Broadcom surging after predicting a boom in demand for its AI chips. The company expects the addressable market for AI components to reach $90 billion by 2027. With the chip supplier extending its double-digit gains pre-market, and there's a lot of excitement around the AI demand. What do we learn from the release? Tom McKenzie has been parsing that for us. Tom, good day to you. Look, it's a very, very clear bifurcation between AI splendidness and the rest of its market, the rest of its product line, isn't it?
It absolutely is, Manus. You just looked at the projected picture in terms of the first quarter, and they foresee growth of around 65% for the AI unit versus about 10% for the rest of the business when it comes to chips, sales into smartphones and EVs, for example. So that bifurcation is absolutely there. Here's what analysts like right now in terms of the numbers. $12.2 billion just from AI sales in the last fiscal year. They had forecast about $10 billion from AI sales. And in terms of the revenue growth, that is 220% year on year in terms of the demand, in terms of sales for the AI products they supply, in terms of processors and networking equipment, year on year, 220%. And again, that addressable market by 2027 of around $90 billion. This is a company that feels like it's very well positioned now on the hardware and the software to address that demand that they continue to see in terms of AI, particularly when it comes to data centers. I'll just give you one quote from one analyst, Cantor Fitzgerald, saying Broadcom is a clear beneficiary of AI and it has a strong technology roadmap ahead. Earnings should continue to come in strong.
Look, we saw them do a pretty big M&A deal. They bought the VMware business for just under $70 billion. When you look at the ambitions of this CEO, what does it say about the future? What does it say about 2025? Because they're inextricably linked to what happens with Apple as well. It's one of their biggest customers.
They are. You're absolutely right. Now, Apple as well is making progress in developing, of course, its own chipsets. So we know that there is some attempt there to wean themselves off the dependency they have on Broadcom. Longer term, that could be a challenge. But they have, as you said, Broadcom diversified. The software part of this business is now bringing in revenues almost equivalent to the semiconductors business, largely thanks to that huge acquisition of VMware. So they have expertise now in terms of the software for data centers, but also cybersecurity. Hancock, by the way, the CEO, saying that he is very ready to pull the trigger on more acquisitions in the year ahead. If you're looking for a fly in the ointment, it will be that still pretty tepid demand in terms of the chips going into smartphones, into autos, and into some of the wireless connection devices they build out as well.
Spoiler alert there from Tom at the end of we've got 15% on the board, and you want to end with a spoiler alert. I like your pragmatism. You sound like myself. Tom, thank you very much. Tom McKenzie there on the very latest from Broadcom. I want to give you a quick snapshot of what's going on with equity markets. We've turned it around since I arrived here at 3 a.m. in the morning. We're now up a third of 1%. The dollar is flat at the moment. You have a raft of central banks pushing back. Canada, double jumbo cut in sequence. SMB yesterday. So the dollar, the next leg of the dollar will, of course, be defined by what happens with the FOMC. 10-year yields trade at 4.33, bang in the middle of that range from 4.50 on the upside down to 4.15. So we'll keep an eye on that. Coming up, we're going to catch up with Jose Torres, Interactive Brokers, as we set up for a major week of central bank decisions.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Krenny. Let's set that agenda. Eking out gains, U.S. equity markets see inflows roll on for a 10th week, hitting $13 billion. SALT talk back on the table. President-elect Trump advisors mull doubling the state and local tax deductions. And an AI boost for Broadcom's rosy outlook as the chip demand sends shares soaring in the pre-market. Good morning to you. Equity markets are indeed eking out a gain. Maybe you want to be cautious on the breadth. You've seen 9th day in a row of where you saw more constituents fall rather than rally. That is the longest run since 2001. But tech is definitely bid up this morning. You've got Broadcom up 14%. We'll talk more about that a little bit later on. So tech is infusing that rally in the NASDAQ. And if you like a little bit of breadth, the Russell 2000 up 0.2%. I can tell you 10 weeks of inflows into the United States. $13 billion came in last week. Bond markets rise very, very slightly. The 30-year auction, they just didn't want to dance with duration yesterday. That was the lovely line from BMO. But we're flat on those bond markets. Volatility in the bond market is at a 3-year low. That was the surprising fact that I came across this morning. So markets, they're bracing for the last round of rate decisions of 2024 from 3 major central banks next week. Jose Torres, Interactive Brokers, is looking ahead to what comes next year. Monetary policy. The outlook for next year is much more complex, with annualized price pressure figures accelerating for a second consecutive month to the loftiest level since July. He joins me around the desk. So, Jose, good morning. Good to see you. Your concern is about the complexities of 2025 and the inflation narrative. Is that predicated more on supply-side disruption that we simply don't know enough about yet?
Great to see you, Manis. Absolutely. We are witnessing a preview of what Trump 2.0 could be. Beijing is already preparing early for tit-for-tat trade jabs across the Pacific Ocean with Washington. Against that backdrop, you also have some uncertainty with Canada and Mexico on trade. However, Canada and Mexico have been acquiescing more so than the Chinese. The Chinese have been a little more adversarial. Why is this so important? Goods disinflation, Manis, drove the disinflation train from 2022 down to that 2% handle on CPI. We got those 3 handles on PPI. You know, eggs drove a lot of the increase, but PPI historically tends to lead CPI. So when the Trump administration enters next month, you know, I'm a little nervous that goods inflation can become a threat. That's been cooperating the whole time. Services inflation hasn't. So if you have services remaining hot, wages, labor market strong, and then goods strong, you're not in a 2% inflation economy.
Well, look, I think it's whether this market can wrap its head around the fact that it's going to be very difficult to get back to a 2% economy in the United States of America. What do you say to the people that look at the PCE, those portions of PPI that roll through to PCE, that they were universally weak? Is that not a strong enough argument for you?
No, because when you look at the annualized figures, which are more slow moving and, you know, take a broader approach, you know, they're ticking higher. And when you look at the trend in used and new cars, right, you looked at the CPI, 2% and 0.6% growth month over month, right? That's a fresh burst. We saw for roughly 2 years, used cars drop almost every single month across 24-month period, right? So we're starting to see that reinflation, also driven by lower borrowing costs, Fed easing, that's opening up credit availability, making those monthly payments more manageable, not just for automobiles, but also for the furniture showrooms, for the electronic and appliance stores, all those durable good categories.
You mentioned China and Canada. I look at the rhetoric in the last 24 hours from Canada, and it has shifted. This is the game theory shifting, which is they're talking about tariffs on uranium, on potash, on oil. I mean, this would be horrendous for the Canadian economy, by the way, if they were to have this kind of adversarial moment. This is the real risk, retaliatory tariffs, not just from Canada, Mexico, but you can broaden that out to the rest of the world. We haven't even started with Europe, and then we don't really understand what the China retaliatory tariffs might look like. That's the other major inflationary risk for 2025, isn't it?
Absolutely. If you start seeing costs increase significantly, you start seeing restriction, you start seeing routes starting to go the other way, that's going to drive costs higher, bring efficiency lower, and weigh on growth, especially in a lot of those areas that are much weaker than the U.S. Canada, namely, the EU, namely, China as well. Those economies aren't as robust as the U.S., considering that our consumption figures here have been terrific. As far as the job market, I'm also expecting that to reaccelerate. You see, I'm seeing a lift in business sentiment following the election. That uncertainty is now behind us, so I'm expecting hiring to begin to pick up. Before the election, we saw a bifurcation in continuing and initial claims. Folks that lost their jobs or quit, taking longer for them to find work, right? The hiring rate was subdued. Now that election uncertainty is behind us, I think that hiring is going to pick up. That should support consumption alongside fiscal stimulus and capital markets. Like you said, inflation at 3%, that is terrific for equities, right? A lack of Fed agitation opens the door to further valuation expansion in stocks.
But then given what you've just said, should the Fed really be continuing to cut by 80 to 100 basis points through 2025?
I don't think so. I'm more of a hawk. Our IBKR forecast traders also think that the Fed shouldn't be cutting. I thought they totally jumped the gun in September with that 50 basis point reduction.
So you think we get one more in December and then we're done?
I think that the neutral rate is right around 4%. Right now the market is pricing in roughly two cuts next year. Financial conditions, we look at the Bloomberg Financial Conditions Index, very loose, spreads very light, corporate balance sheet strong. The other financial conditions indices, for example, Goldman Sachs, Chicago Fed, telling the same story. We're in a very buoyant, animal spirit-filled economy. Look at the rally we're seeing. We're going to have probably going to have a Santa Claus rally to finish off the year. We're going to be up 30%. Last year we were up 25%. Come on, this is not restricted.
I'm coming to your Christmas party. So I mean, Goldman Sachs said yesterday this market is trading as if it's got a 7% growth handle on it. The kind of outlook that you've got at the moment, I mean, it's just nirvana for all assets, is it? I mean, what is the single biggest risk to that bullish view that you put on the table?
Well, I think the biggest risk is going to be an exogenous shock, right? I don't see anything right now that can totally derail, equities. I grew up as a value investor. That's been my forte. So I've had to rewire my brain in terms of how I look at these financial assets. But the equity market is significantly different than it was 20 years ago in terms of who's leading the ship, right? And what the profile of the companies that are really taking charge. It's less financials, less energy, totally different.
Can I just pick up on one thing? You got jobless claims ticking up yesterday. You've got an unemployment rate of 4.2%. Why are you so convinced that perhaps that's the worst in the labor market behind us? Is that what you're saying to me?
Well, the unemployment rate is up to 4.2%. Cycle low is 3.4%. During that time and that uptick in the unemployment rate, we added roughly between 2 and 3 million jobs, even though the unemployment rate went up 1%. That is critical to examine, particularly next year when we're talking about immigration, possible enforcement actions, possible deportations. Because we know in the unemployment rate calculation, the denominator is the labor force. So if that declines, if people go back for whatever reason, right, all else equal, the unemployment rate will tick up, even though the number of unemployed persons remain the same. Now, that's going to be inflationary from the wage side. However, reduced immigration could counter the disinflation on shelter costs, perhaps.
Okay, Jose, good to have you with me this morning. I'm coming to your Christmas party because it sounds like all the bulls are going to be there.
You're invited.
I'm invited. There we go. We're going to Miami. Jose Torres of Interactive Brokers on the markets this morning. Coming up, we'll discuss what's next for the credit markets. Wells Fargo's Maureen O'Connor joins me around the desk. Let's say that we see whether she shares Jose's euphoria for credit. Good morning from Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We've seen the market rally by roughly 5% since the election. You saw recently the NFIB Small Business Optimism Index jump sharply. That's pretty consistent with what we saw in the first Trump administration. The expectation of more business-friendly environment, whether that's true or not, of course, that remains to be seen. CEO confidence is typically highest in a unified Republican government. So that also is, I think, one of the reasons why you've seen we are expecting a 25% increase in M&A activity next year.
Goldman's David Costin looking at a strong M&A market. It'll be boosted by 25%. Does she agree? Maureen O'Connor, Wells Fargo, echoing that view. This is what she says. Debt-financed M&A should remain robust as resilient economic conditions and the possibility of a more favorable regulatory environment drive the incremental acquisition activity. Maureen joins me now. So it's gangbusters for M&A and deregulation. I don't know whether you can sort of follow Jose with a level of enthusiasm, but let's start with the M&A market. There is a big assumption here that we are going to see a material uplift in M&A next year.
Yeah, I mean, I think, listen, the conditions are right? In the lead-in, you heard about C-suite level confidence. The Fed has stuck the perfect no landing scenario. At least that's the way it looks right now. Debt financing costs, while they're elevated, still remain within historical norms. So I think that the cost to finance M&A, at least from my market's perspective, feels digestible. We did see an uplift in M&A activity this year as it pertains to the impact on investment-grade credit markets, but we are expecting another roughly 25% boost, so similar to the opinions leading into this segment. So yes, it does feel like the market is ripe for some M&A. There are certain sectors that still look poised for consolidation. Pharma, perhaps energy, some more in tech. So yes, we are expecting a robust calendar.
And if we try and transcribe that flow sheet that you just laid out into issuance, how does that look?
Yeah, so issuance on the investment grade side has been pretty strong. This year we're up close to 30% on a year-over-year basis. We're expecting another 10% growth in overall issuance activity. M&A is a part of that. Right. So we are again expecting a roughly $250 billion of M&A supply in investment grade on a probably $1.7 trillion number. But the vast majority of the issuance in our market is really just refi needs. When you think about the maturity towers coming due in the next couple of years, they they are large. We have $850 billion in maturities in 2025. We have $1 trillion in maturities in 2026. These are record levels for our market. So the market grew after COVID, right? The Fed pumped liquidity into the market, balance sheets inflated. We saw a ton of issuance in 2020 and 2021. The 5-year notes that were issued in those years are maturing, and so we must stay larger.
It's interesting. If I look at the sovereign issuance this week, I think we can walk away with where is demand, which is there was healthy demand for 10s. That's robust. That's fine. You know, that was an appealing yield. Nobody wanted to dance with duration in the 30-year bonds yesterday. Now that's sovereign, but translate that into your world. What are you seeing in terms of the preparedness to dance with duration?
That's interesting because actually pretty consistently for the last 2 years, it's the long duration bid in our market that has been the strongest.
Okay.
And the reason for that is when you think about who buys investment grade credit, there's a diversity of investors that prop up our market. And a big component of that is U.S. institutional money, and that's driven largely by LDI strategies. So liability driven investors, insurance companies, pension funds, guys that like higher yields. The pension rotation trade has been well underway now for a couple of years. All of those flows, long duration and focus, because those are matched liability trades. So yes, we actually see deepest bid in 30s, followed by 10s, followed by the short end of the curve.
I suppose the structure of your demand side will drive that, but you're not seeing a massive cheapening up in spreads to get any of this refinancing away either, are you? There's a healthy demand.
Healthy demand. In fact, this is the stat I like the most. Our market issuance was up almost 30% on a year-over-year basis. New issue concessions, so the premium you pay over and above your outstanding paper, that actually compressed by 50% in 2024. So that speaks to how strong the demand dynamics are in our market.
Maybe it also speaks to that people want to take quality. You know, I know there's the whole other rest of the spectrum in high yield and one thing and another, but within your world, which is an investment grade, it is about holding on to quality. Look, we can quote the spreads the tightest in decades in different parts of the markets. I asked you, were you as optimistic as Jose when you sat down in the commercial break? How would you describe your risk appetite at the moment for your market?
Yeah, I mean, I think if you surveyed investors, the overarching sentiment is everybody is optimistic, but cautiously long. You are correct. We are sitting at decades tights in spreads. And, you know, there are little pockets where perhaps there is still some value relative to historical norms, but we're in very rare air here with respect to valuations. They're stretched pretty thin. So what's the upside from here when the market does appear priced for perfection? But at the same time, given the demand dynamics that we just spoke about, it's very hard to be short this market. It's not a trade that's made you any money in the last 2 years. So as long as yields remain elevated and the world feels like a pretty safe place to invest, credit markets are going to be pretty well range bound from a spread perspective going forward, and that's our view.
If we talk about 2025, the risks, in equity land, Julian Emanuel in that seat on Monday, and he talked about this exuberance, but the risk is of an exuberant correction. Translate that from equity into your world, because the equity boys and girls are concerned that there will be moments, air pockets in terms of the news flow, in terms of policy flow. Will it be the same in your world?
I mean, I think, sure, exogenous risks are there, and I think that's looming in everybody's heads. You know, what is it that I'm missing? And when we see it, we'll be surprised.
And that's maybe what imbues the caution, the little bit of cautious up.
Correct. I mean, exactly. There's almost no downside risk priced into spreads right now. So what do you do as an investor? You know, those pockets, we have seen them. You know, I think about this past year, you know, we did have a bout of volatility over the summer with the non-farm payroll miss and the yen carry trade that unwound at that time. Spreads felt that. It was about 2 days of real market volatility. Dips were bought. They were bought pretty aggressively. So obviously it depends on the severity of the event. More systemic risks like we saw during the regional bank crisis in 2023, that was a handful of weeks before spreads really recorrected back to their prior volatility, you know, prior catalyst levels. But the reality is investors, the liquidity that is available on the sidelines ready to buy the dip, I don't see them being long lasting to the extent that these are, to use your term, sort of pockets of volatility.
Maureen, great conversation and a healthy level of caution let's say, in the calls. Happy holidays. I think we're doing that at this stage. Maureen O'Connor there of Wells Fargo. Thank you for joining me this morning around the desk. Let's switch gears a little bit. Let's get back to politics, because that is these markets, essentially. President-elect Donald Trump, his team, is considering doubling a popular tax break. It's the SALT tax, and it would provide big savings to high-tax states. New York Governor Kathy Hochul calling the plan, quote, nothing more than an empty gesture. She goes on to write this: it fails to deliver the meaningful relief for working families desperately in need as they struggle with rising costs. I fully support a proposal for a complete restoration of the SALT exemption. Joshua Gallo joins me now. Josh, good to see you. Look, this is about a doubling of SALT. I think the possibility of something more unbridled is very, very low. But this is a razor-thin Congress. And the question is there an appetite in Congress to do something very, very significant with SALT?
That's exactly right. It comes down to that congressional margin because, you know, in the end, we're talking about changing it from 10,000 to 20,000. And this is something that, of course, was lowered to 10,000 in 2017 by Trump himself in his tax plan. So it's set to expire next year. And the fact is, this tax break, as the governor pointed out, it really is most beneficial to people who are pretty wealthy. They're in states like New York, New Jersey, California, where people are paying high property taxes. And, you know, it doesn't really benefit that many other people. So, you know, whether it would be, if they made it unbridled, as you suggested, is very unlikely. Even Stephen Moore said they wouldn't do that. That would be a massive handout. But at the same time, you have people in Congress from New York and those states who are really pushing to reinstate or at least lift it to 20,000.
Well, of course, that's New York, New Jersey, and California. They're going to welcome any shift, you know, from where we are at the moment. I want to talk about one of the stories in the Journal. We understand that the advisors are wanting to shrink or completely eliminate some of the bank regulators. I mean, this is really quite a surreal kind of proposition. It would be to merge or eliminate some of the bank regulators. Think of the FDIC, the Office of Comptroller, and of Currency. Again, this would take Congress to get this kind of dramatic shift in legislation, but it also involves the possibility of the insurance policy, the deposit insurance policy, being absorbed into the Treasury.
Yeah, that's complicated. Anytime there's significant change to financial regulation, there are just a number of parties that come out and the fight is intense. You know, I think there are really two sides to this. One is this drive for efficiency driven by Elon Musk, of course, in the new office. And then on the other side, a desire to always simplify and in many cases remove regulations, which is obviously a clear priority of Trump's administration. So, but the fallout of that, right, to real people is very hard to gauge. And when you talk about something like deposit insurance, any kind of change to that is a massive signal to depositors that could have quick ramifications of people moving money, losing confidence. So that would be taken with pretty careful steps, I would think.
Josh.
Then on the other hand, you have the push for deregulation, which is another ball.
Of course, and let's see what scale of that is delivered. Joshua Gallo there on the very latest political stories on Bloomberg. Coming up, President Biden attends his last G7 meeting. We stay on watch for a new French Prime Minister right here on Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
A look ahead through the weekend for you. President Biden will join a virtual G7 meeting as world leaders brace for Trump's return. To France, President Macron is expected to name a new prime minister probably today. And the vote on the impeachment of South Korea's President Yoon is expected to take place on Saturday. So by Monday morning, you're going to have a feast of news potentially. Broadcom is absolutely powering ahead in this pre-market trade. Pretty strong news on their AI sales surging. Norwegian Cruise, another upgrade raised to overweight at Barclays. And Warner Brothers is dropping double-digit gains in the previous session on the back of the announcement of a restructuring of the firm.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
We have to look for the risk of some shock effect coming in that distorts sort of the euphoria that we've been contending with.
I'm not running away from U.S. stocks, right? But the idea is, do you get a broader market in the coming year?
When we head into next year, we could have shocks from either trade or fiscal policy.
Over time, those higher rates start to bite, and I think the Fed will have to capitulate at some point.
It's really important to stay pro-risk, to stay pro-growth. Just recognize that the range of outcomes is going to be wider.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Here's the good news. It's Friday. Here's the bad news. It's Friday the 13th. The S&P 500 poised for its first weekly loss in a month after a roller coaster week, and there's something spooky going on under the surface of this exceptional U.S. equity story. There have been 9 consecutive days with more declining stocks than gainers, and that is the first time that has happened since 2001. Right now, the state of play is as follows. Futures trying to claw back some of this week's losses as yields go nowhere. NASDAQ futures leading the charge once again, as they have throughout this entire period of time, up 0.7%. Danny, what strikes me again and again is that, and we can make all the puns in the world, that breath just is not so good.
It's really not good, and it's happening both at the end of the year and the earnings season. And you see some really uneven reactions. You see Broadcom up some 14% at one point pre-market versus Adobe falling 14%. As stocks get more expensive, you have this idea that the margin of error is a lot thinner. And what you get is a more bumpy road. You don't get stocks all falling together, something crazy, but you get bad breath and a market that's more difficult to navigate.
At the same time, there is money flooding into U.S. equities, poised for a record $480 billion of inflows this year into U.S. equities. How much of the hiccup right now, Anne-Marie, is just this idea that maybe we're facing some policy uncertainty and we're waiting for some of the optimism just to be borne out?
A ton of policy uncertainty, but to your point, there is this U.S. exceptionalism. When you look at the global equity benchmark, it's closing out one of the worst weeks in a month. When it comes to the policy uncertainty, tax cuts. Now we're starting to get those negotiations when it comes to things like SALT. Policy uncertainty on tariffs. Canada mulling these ideas for retaliatory measures, which could be inflationary. And then, of course, yesterday, Donald Trump came out on the side of the dock workers. Does that mean maybe we're going to have a protracted, long fight when it comes to the dock workers and potentially imports coming to the United States? So much uncertainty on the horizon. But again, risk markets don't seem to care. And I thought Michael Hartnett from Bank of America's note was interesting in this regard this morning, because he says that the thing that disrupts the equity rally isn't the policy, isn't any kind of tariffs that we would get. It is central banks. He says the time to stop buying equities and to buy bonds is when the Fed turns hawkish, not anything to do with the policy.
Well, maybe we'll get that opportunity next week, although it does seem somewhat unlikely. We do expect that Fed decision on Wednesday, the last of 2025, at a time where it's expected to be 25 basis points. I feel like Christine Lagarde offered up a note of caution yesterday because she came out, she dropped this idea of sufficiently restrictive rates, and yet there was this sell-off on the heels of not enough dovishness. So to Danny's point, Anne-Marie, it seems like there needs to be an overly dovish kind of feeling to really justify some of the moves that we're seeing.
Right, and potentially we're going to get that next year because, yes, it's going to be when the central banks moves, to Michael Hartnett's point, but what's going to be the catalyst that moves him? And is it the change of policies, especially when it comes to the political economy, and all of that is centering around Washington, D.C. in a very protectionist administration to be?
Well, this is a state of play today on surveillance. Coming up, Chris Verone of Strategas on high expectations for equities heading into 2025. Wendy Schiller of Brown University as Trump considers doubling the SALT write-off limit. And Leland Miller of China Beige Book as China signals even more fiscal stimulus. We begin this hour with tech leading stocks higher as traders await next week's Fed decision. Chris Verone of Strategas, a Baird company, looking ahead to next year. Today, the average 2025 S&P forecast is 66.81, just about 10% higher than the current levels. The bar of expectations for the market is considerably higher today than it was a year ago, with sentiment hot There is small room for error in the first half of 2025. Chris joins us now. Chris, great to see you.
Great to be here.
Welcome back. I just, I'm not going to go with the puns, although I kind of want to. What do you make of the fact that we're just seeing such limited breath, or bad breath, in the market right now, with so few stocks gaining amid the recent eking out of some of the tech stocks?
Yeah, frankly, I think it's a little overstated. I mean, this is 2 weeks of some squishy internals. It's not 2 months or 2 years. The entire year, 2024, we've had between 70 and 85% of stocks above the 200-day moving average. So this has been relatively broad for most of the year. I think the bar has to be higher before you say, oh my goodness, the breadth is deteriorating to such an extent where it sends this awful message about what's going on under the surface of the market. I don't think we're at that point yet. We're in the middle of December. As we know, it can be a seasonally choppy period here these next 2 or 3 weeks. You tend to resume with strength into January. I think the question, Lisa, will be, does the market justify or does it continue to justify the level of bullishness that's out there? I mean, you start the segment by talking about what the expectations are for next year. So I think as analysts, we have to ask ourselves, is the market still living up to the hype? And that'll be the big question for us over coming weeks.
What is the hype? And I ask this because is it earnings, is it policy, or is it Fed? Which is the most important hype for this market to live up to?
Well, I think there's clearly this awakening of animal spirits. You see it in the targets. The attitudes from the sell side today are remarkably different than they were a year ago. We did that exact same study 12 months ago. The street was looking for basically an unchanged S&P in 2024, and what are we up, 25%, right? So there's clearly a resetting of expectations here, and I don't think that's fatal or catastrophic, but you know what we've always tried to answer is, does the market justify that level of enthusiasm? I think the good answer so far is largely yes. I don't think the internals have deteriorated to such an extent. I think the leadership is still pretty pro-cyclical here, but as we write, our margin for error has to be smaller than it has been in the past because the expectations are high. You know, and I think, interestingly, you kind of hint at Europe here a little bit, where the setup's the exact opposite is probably in Europe here. I think the expectations are remarkably low for something to go right here. And it could be any number of things. It could be China getting better. It could be peace. It could be any number of things. But when you're talking about 40 and 42 PMIs in France and Germany, the bar is really low for something to go right there.
A low bar for Europe and China, a high bar for the U.S. I found it so interesting, though, that you've just been on a tour talking to clients.
Yeah.
And a majority saw the next move being 10% lower in the S&P. What did you think about that?
You know, it was such an outlier. We've basically been on the road every day since the election. It's been a busy 6 weeks. I'm happy to be back in New York. But what's been such a consistent feature of all of our client conversations for 4 or 5 weeks is this unleashing of animal spirits. And then something happened over the last week where attitudes have shifted here a little bit. They've become a bit more restrained or modest. I don't know yet if that's an outlier or if people are seeing something. But I'd say on balance, if you look at all of our sentiment indicators, empirically, they're falling somewhere between the 85th and 90th percentile historically. So we're kind of right in the zone where you got to maybe watch your back here a little bit because it's never what you know that hurts you. It's what you don't know that gets you. And there's probably something out there that we're not thinking about that could be an issue some point next year.
But this is the thing, and I mean, Lisa started out with this. You so rightly call out that the forecast this time around last year was a gain of less than 2%. And it really paid off to fight the bears. It paid off to not listen to them and go full in. How hard is it to fight the bulls? How hard is it to fight momentum like this, even if at times it seems a little bit on the edge of euphoric?
Yeah, well, I don't think you can yet because I still think the market's living up to the hype, and you see it in a couple places. Number one, credit conditions are remarkably benign here. I think if something meaningful is going to shift out there, you're going to see a deterioration to credit. I think, secondly, the leadership on balance is generally pro-cyclical, right? That's been a tenet of this rally all year. So if I'm going to change the call, I need the consistent stuff to deteriorate, and neither credit nor leadership have really to any meaningful degree. I think the three things you can kind of watch here to maybe shift opinion, notice how post-election equity vol and bond vol have collapsed, right? But what hasn't? Currency vol has not. Currency vol is kind of still near the high as it was pre-election. So I think if something is bubbling or brewing out there that we're not focused on, maybe it emanates from a currency markets here. The dollar CNH looks like it could be lost higher here. We've obviously seen the move in the euro. I think if something, or even dollar yen, I think if something's brewing that's unexpected in 25, it probably comes from currency, not from credit, rates, or equity.
When you say that potentially you're talking to these clients who think, in the last week at least, those final clients on your road trip around America that think we could see the 10% pullback, is the reason because of the policy uncertainty, or they just think maybe we're getting a little bit too lofty with these valuations?
Yeah, it's more the latter. I think ironically, there's an embrace of kind of what the proposed policies are looking forward. I mean, we were talking about this somewhat casually yesterday in a meeting. There's a kind of a 1980s feel out there right now. It's certainly not lost on me. I do think, speaking in the context of sentiment, again, it's emblematic of an environment where the bar has certainly been raised here. I think the expectations are pretty lofty going into next year. What we've seen historically is when you've had a change in power, the market tends to run until the inauguration, and then the spring is just a chop. I'm not opposed to the outcome here, but we'll certainly call it as we see it.
You've been constructive on China.
Yeah.
What do you make of the latest we've heard out of China in terms of looser fiscal policy, looser monetary policy, but still very thin on the details?
Yeah, we've always kind of said with China, it's not my opinion or your opinion that matters, it's the market's opinion. And I think the way the market has interpreted the hints of stimulus that you've seen over the last several months from there is different than how it interpreted everything else the last 2 or 3 years. I mean, the momentum surge you saw in September was significant. And I thought the consolidation in the months that followed, the last 2 months, was pretty benign. And you get some kind of renewed signs of life this week. What's important for us in China, consumer discretionary is leading. It's odd for me if we're still in a black hole, recessionary, apocalyptic environment. The financials act pretty well. Chinese tech is breaking out. So I think it would be silly not even to be open to the idea that something's changing out there. And what I encounter traveling and talking to clients is complete resistance to the idea that something's changing. So be open to it. Most people don't even know China's outperformed this year. FXI's up 40, NASDAQ's up 25. So it's already happening, and there's a complete disdain or neglect for it.
Not a complete disdain. We just saw the biggest inflows into Chinese stocks going back to 9 weeks. So we do see some sort of acceptance of this idea. But I am wondering, going forward, putting all of what you just said together and given how high the bar is in the U.S. and how low the bar is in Europe and to some degree in China, are you overweight Europe and China and basically shifting away from some of the high calls in the U.S.?
So we're not overweight those parts of the world yet, but I do think it's a good exercise kind of at the end of the year as the calendar gets ready to turn, just to reset the chip stack and kind of get closer to the benchmark. And I want to kind of get closer to the U.S. benchmark. It's smaller, and I want to get a little bigger elsewhere. I do think there's the potential for good surprises in other parts of the world. If I can make one last point, I would encourage everyone to go look at the European defense contractors. They're all breaking down. When did they break out? They broke out at the start of the war. Is something imminent, peace brewing in that part of the world? I want to be open to that.
I want to be open to that, too. Chris Verone, thank you so much for being with us. Chris Verone of Strategas, a Baird company. Always wonderful to see you, and I think that we can officially launch Happy Holidays.
Yes.
Happy Holidays. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Hackes. Yahaira.
Good morning, Lisa. The suspect charged in the killing of the United Health Group CEO was not a customer of the insurance. Luigi Mangione and his mother were not members of United Healthcare, dispelling the idea the shooting was motivated by a personal grievance against the country's largest health insurer. Mangione is currently being held in a correctional facility in Pennsylvania while he fights extradition to New York. Meanwhile, Bloomberg reporting Canada is considering imposing export taxes on commodities like uranium and oil if the U.S. imposes broad tariffs. The move would drive up costs for U.S. consumers, farmers, and businesses, and risks causing political divisions within Canada. According to officials familiar, the export levies would be a last resort for the country. And Broadcom shares are rising 13.9% after its fourth quarter results beat expectations. Its artificial intelligence revenue growing 220% compared to the year prior. And that AI growth shows no signs of slowing down. Broadcom expects to see 65% growth in its AI product sales in the fiscal first quarter. That's faster than its overall semiconductor operation, which it expects will grow just 10%. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. They just said AI in the right way. It was sort of really interesting because they didn't really outperform in any other way, Danny. That was sort of interesting.
Yeah, because again, you look at Adobe, who also didn't outperform, performed in line, also mentioned AI, completely opposite treatment. So make of it what you will.
Maybe it's all the Apple rumors. Anyway, we'll talk about that later. Up next, the Trump agenda.
The economy, I believe, is going to be very strong. We do have to solve some problems. They have happened, and I want to get them solved.
That's coming up next. This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Trying to break what would be the first weekly loss going back a month. Good morning. Welcome back. We are seeing futures just mildly higher, led by big tech, which has been the main driver of any gains we've gotten so far this week, up 0.3%. We could see a little bit of euro strength, but little bit being the operative word here. Dollar strength across the board otherwise, and really it is the dollar ascendant. Yields creeping a touch higher, but yesterday really climbing through that 433 level. A big question about how much this relates to inflationary pressures and how much this has to do with the deficit. Under the surveillance this morning, the Trump agenda.
The economy, I believe, is going to be very strong. We do have to solve some problems. We have wars going on that we didn't have. We have a lot of things happening that we didn't have that would have never happened. They would have never happened, but now they have happened, and I want to get them solved.
Here's the latest. U.S. President-elect Donald Trump pledging to build a strong economy and cut taxes during a trip to the New York Stock Exchange. Trump's economic advisors now considering doubling the state and local tax deduction to $20,000. Wendy Schiller of Brown University writing, Trump has momentum and has set expectations high about what he and the GOP can accomplish to improve the daily lives of working Americans. Trump will also have the advantage of passing a tax cut bill by the end of his first year. Wendy joins us now. Wendy, thank you so much for being with us. I want to start with this idea of the SALT tax deduction and this idea that there are only a few members of Congress that are really pushing for this, but margins are so slim that President-elect Trump has to cater to them. What does that tell you about the path ahead and how difficult it's going to be in terms of pushing through all of these agenda items?
Good morning, Lisa. Well, this is the big sort of mystery about the 2024 election. Trump won. He didn't win 50% or higher, but he won, and he won the swing states. And he looks like he's got a lot of momentum, at least with his cabinet nominations and the Senate right now. The House is really a puzzle. There are almost no coattails at all, and the House margin has shrunk. Not only because they didn't do better than they should have in 2024, but because he's selecting people from the House. And in fact, Elise Stefanik, that's a big reward for being so loyal, but she's from New York State, a state that would want, some change in the SALT tax deduction. So this is a real problem for the advocates of changing this particular feature of the tax system back to where it was, or at least improving it for people who come from high tax states. Getting even anything through the House of Representatives, and this is really crucial because constitutionally they originate tax and spend bills, is going to be an enormous challenge for Trump. And he doesn't really care that much about Congress. Most presidents, by the way, don't care that much about Congress. But in this case, I'm not sure what leverage he'll be able to use.
Well, when it comes to SALT, and you mentioned that, we reported that the economic advisors around Trump are looking to raise the SALT cap to $20,000. And then almost immediately you have Congressman Nick LaLota of New York coming out, tweeting the Bloomberg story and saying $20,000 is not reasonable and that he won't vote for anything unless it's a reasonable increase. Just when you take one story like SALT, how difficult is it going to be for Republicans to get that over the finish line, given the fact historically this is the thinnest majority Republicans have ever had in the House of Representatives?
Well, Anne-Marie, I mean, this is Congress 101, House Politics 101. Mike Johnson, will survive. Trump has sort of indicated he wants him there, and he's going to have to work the line, so to speak. He's going to have to log roll. There will be other features of this tax bill that congressmen, particularly sort of very conservative congressmen from particular districts, are going to want or need. And the second thing is, if you want to log roll, if tariffs really do go in place, and we see the impact on farmers that we did in the first Trump administration, they're going to need subsidy help again. And then New Yorkers, Illinois, California, they have a big agriculture industry actually in all three states. They could benefit by log rolling for both of those constituencies in their state. So this will be House 101. What do you trade to get what you need? And I think Trump generally is likely to stay out of it, but expect his Treasury Secretary to be really working those phones and working those votes as well.
So where are they going to offset the cost for all of this?
Well, offsetting costs seem to be, something Congress doesn't seem to feel like they have to do anymore. I mean, it's been a long time since sort of the grand bargain. And even though bargain technically fell apart, Republicans still got $80 billion worth of cuts in the budget. We haven't seen that in a long time under a Republican president and a Democratic president. So where anybody's going to be willing to cut is, anybody's guess. And the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. And you can think about economic growth, you can think about a stable economy, but sooner or later that debt will catch up with us.
Well, Wendy, we started out talking that there's disagreements over SALT, but there's disagreements in just even how to phase in these various proposals. There's been reporting this week that John Thune wants basically two reconciliation bills, border energy first, tax second. And then you have Ways and Means, Jason Smith, saying, no, we should put it all in one big bill. It'll jeopardize Trump's ability to get tax cuts extended. Wendy, the fact we don't even have an agreement on that itself, on the very basics of what these bills look like, what does that mean for timing? What does it mean for sequencing?
Well, Danny, this is the big sort of curse of a trifecta, because the rules of the House and the rules of the Senate still remain quite different, and the margin in the Senate's a little bit more comfortable, but you still have to think that Murkowski and Collins are a little bit wild card. You just don't know exactly where your votes will be, but Thune can sort of get that through the Senate without a filibuster. Reconciliation only requires 51 votes. He's got enough votes for that. So he's basically saying to the House, if you want a victory, send me a quick bill now, because I can get it through the Senate now. We all know that as things move along, the summer, debt ceilings, appropriations bills, the docket gets crowded. So if you want to get something done and claim victory, you have to do it relatively early in the Congress. And you can see reconciliation is a much more beneficial process because of the rules in the Senate. You won't have a filibuster. You can get it through. This is why Thune wants to do it now. There are always differences between the Senate and House leaders, even if they're the same party. We're just seeing that Mike Johnson has very little leverage because he has such a small minority. He literally cannot guarantee anything to John Thune.
Wendy, you write that you basically need to get some of this through in order to improve the working lives of everyday Americans. Is it your estimation then that tariffs won't be able to be passed, at least the most extreme of them, because of the impact on everyday Americans, that it will not be the stock market, but it will be inflation that holds Donald Trump back?
Well, I think that he will use tariffs selectively. That's what I guess. It's hard to predict Donald Trump. Selectively now because he said he was going to do it. We see that China, they're not attending the inauguration. I don't think nobody's really that surprised about it. But nonetheless, using negotiation, using sort of overtures of friendship to China rather than tariffs may have been his opening gambit. But maybe if that's all rebuffed, he'll have no choice but to impose, continue some Biden tariffs and impose new ones. Let's see the inflationary effects of those tariffs and the supply chain effects of those tariffs. And if we get to June or July and things are really sort of crunching, then Trump's going to have to, backtrack, and that's going to make him unhappy. And then, as soon as we get to September of 2025, all the House members start looking for the election of 2026. So there isn't really the longest window, but there is a pretty fair, couple of months for Trump to try to see if he can get that balance right where he doesn't trigger inflationary pressure. Because that is something, if he doesn't literally fix the price of eggs, that's what people can, keep talking about, milk, bread, and eggs. If he doesn't fix that, then 6 months from now, the sheen could wear off on him. And with an unstable House, that sort of bodes, danger signals for the Republican Party.
Maybe he can change bird flu. Wendy, I just want to finish up with this. There is this question, especially with the latest discussions around the dock workers, with President-elect Trump siding with them. From the initial signals, is this a pro-labor or pro-business president?
Donald Trump is pro whoever is sort of saying really nice things about him at any given time. That's what we've seen before. He'll try to sort of use both sides against each other to negotiate. That is one thing he likes to do. He likes to be the man in the middle. He likes to be the hero, and he likes to get a deal done. Whether that deal is a good deal or a bad deal for particular parts of the negotiation team, that can be debated. The point is, he likes to do that. So his team around him will try to get him in the room for as many conflicts as possible to get some victories, which makes him happier, which I think we've seen makes him a little bit more reasonable as we progress on a large set of difficult issues.
Wendy Schiller of Brown University, thank you so much for being with us. I just keep going back to that. Which is it? Pro-labor or pro-business?
I think Wendy makes a great point. So whatever the deal is on the table that he has to get through. Yesterday, he was certainly pro-labor when he went to meet the dock workers.
We've got more coming up on that in just a minute. Coming up, we also are going to be speaking with Leland Miller of China Beige Book as China promises to backstop the economy, maybe fueling some of the flows that we're seeing into Chinese equities. This is Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something. There's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It is Friday the 13th. Welcome back. We're looking at a market that's trying to snap what would be the first week of losses going back to about a month now. We're looking at losses that have been pretty dominant in the broad market, but not necessarily big tech. S&P futures up 0.3%. NASDAQ futures leading the charge, as they have continued to do throughout the week, up 0.7%. Russell 2000 futures doing all right today, up about 1/3%. But Danny, yesterday, really underperforming, as we really did see just a couple of names leading the charge across the board throughout the past week.
And if you were to say, okay, forget everything you know, just look at the odds for what we're going to get for a cut, you would have said, small caps off to the races. We're pricing in nearly in 100%. I think it's like 97% odds right now that we get a cut. We also have the gift of cuts around the world, but still, that's not benefiting small caps. Expectations for a Trump administration, that's not benefiting small caps at this moment. Perhaps it just reflects the hesitancy at the end of the year and the concerns for what the inflationary environment's going to be in 2025.
And to Chris Verone's point, this idea that a lot of high expectations have already been baked in. So that's something that we saw yesterday with respect to the ECB coming out, cutting rates by 25 basis points. The read-through in yield space was not what you would expect. Take a look. 2s, 10s, and 30s in the United States all inflected higher after yesterday's punishing session, even after an auction that was but it was at least not terrible from the internals. But really in Europe, we saw that sell-off gain steam after ECB President Christine Lagarde came out and didn't really give a sense that she was going to acknowledge some of the deep pain.
Didn't acknowledge it, although she did give a nod to the fact that Europe right now is in political paralysis, but potentially she thinks maybe in 2025 that political paralysis will start to evaporate, given the fact that we're going to get a new French PM and potentially we're going to have elections in Germany. But many say she could have leaned more into it, given on the horizon, there's so many unknowns when it comes to trade policy and how difficult it's going to be for the core of Europe to deal with President-elect Trump.
Committing or sort of suggesting 25 basis point rate cuts would be the path forward, even as they were moved sufficiently restrictive to their benchmark target. The euro gaining a little bit versus the dollar, even though the dollar otherwise has been completely ascendant. Maybe part of this has been this idea, Danny, that if ECB President Christine Lagarde isn't more dovish, that might give some sort of relief to a euro that's basically been flat on its back.
Yeah, it's true, but to some degree, maybe you want a euro that's flat on its back in order to deal with some of the tariffs that might be coming and the weak growth. I think it also just underscores and maybe is a preview for what we're going to get next week. This idea that you can't necessarily know which way the bond market is going to be just given on what the headline decision is. We saw that from the Fed last time around, that they cut and yields just move higher. In Europe, they cut, yields move higher. It's unpredictable, and it's at a time where bond market volatility is already very high. It might get higher, especially in the U.S. with concerns around auctions and growing deficits. There are just so many cross currents and so many different things moving this market that it seems like the one constant is just choppiness.
And that's over to you, Fed Chair Jay Powell, on Wednesday, when we might get some sort of choppiness as well on the heels, not just of the rate decision, but also what the telegraph is for 2025. Under surveillance this morning, the latest on this story, United Health Group saying the suspect charged in the killing of executive Brian Thompson wasn't a member of its insurance plans. The company adding that Luigi Mangione's mother was not a member either, dispelling the idea that the alleged shooting was motivated by a grievance from his personal experience with the insurer. starts to ask the question, begs the question, Danny, how much are we looking at something that speaks to an idiosyncratic moment in someone's psychological trajectory versus some sort of overarching bigger statement?
So the New York Times has a story this morning that's really remarkable that basically tracks the last few months of this alleged shooter's life and kind of the downturn he went into. And what you get is a disturbed picture of someone who travels to Asia, friends, family can't get into contact with him, severe mental decline, severe feelings of wanting to solve things with violence, which of course is never the answer. It's not something, you know, that should be lionized. And I think that's the kind of picture you get in some of this reporting is this is someone who is deeply disturbed.
Going back to what the NYPD said, though, the fact he is not a client of United Healthcare, but they said the suspect wrote that the police talk about in this evidence, quote, does make mention that it is the 5th largest corporation in America, which would make it the largest healthcare organization in America. This is what he wrote going into this tragic murder.
Well, and that will proceed. In the meantime, President-elect Donald Trump expressing support for the International Longshoremen's Association after meeting with leaders. The union preparing for a potential strike on January 15th over the use of semi-automated cranes at port terminals. AMH, we already saw this torpedo some of the operations on docks in the United States. A real kind of about-face from somebody who people can't really identify whether he's pro-labor or pro-business.
Well, he comes out with this statement, and he's clearly backing labor when he says this. And he says he's studied automation and know just about everything there is to know about it. This is his words. And he's basically saying it's not worth it if it's going to put the workers' jobs at risk. The other thing we should note from Donald Trump and the incoming administration, he picked a very union-friendly labor secretary, and that's put a lot of Republicans on edge. But this is the Donald Trump that's a populist, and it is a different kind of Republican than maybe people would be thinking when they think about how he's going to communicate with unions. And you could see that from his cabinet pick, and you could see that from his meeting yesterday.
Yeah, it's a different generation this time around of GOP. Part of the thing that I find interesting is when these negotiations were first going on, when it was Biden's team talking with the ILA, talking with the USMX, the employers for these people, there was this idea that the ILA had so much leverage at the time, they wouldn't get it again, just because they were dealing with the most pro-union friendly government in history, and that the time would pass once we had the election. That's not what's happening. Instead, you're getting another administration. You're getting Trump, who is saying, I support the union members. So it seems like the leverage is back in their hand, which maybe for the employers was a miscalculation to not come to an agreement sooner and just kick the can down the road until closer to the inauguration.
If you're trying to come up with some sort of cohesive, overarching strategy, well, join the club, because that's what's happening around the world. China is one of them, and they have been trying to proactively move ahead of President-elect Trump moving into office. China signaling more public borrowing and spending in 2025. The announcement coming after a 2-day meeting of the Central Economic Work Conference in Beijing. Top officials making lifting consumption and stimulating overall domestic demand their top priority for only the second time in at least a decade. I want to stick with China for a second, because Leland Miller of China Beige Book is going to be joining us, and he writes, the economy is still weak, but not catastrophically so, and thus Beijing's focus is not boosting the economy. Bigger stimulus will come if Trump's tariffs come, and they need it. Otherwise, they will continue to do as little as they can to keep the economy stable. Leland joins us now. And Leland, I just want to start there. Do you disagree with some of the euphoria that we've seen in certain markets embracing the idea of more Chinese stimulus?
No, of course. But, you know, there's something very different between stimulus that's supposed to juice short-term asset markets and, you know, long-term stimulus that's meant to, you know, restructure the economy and restructure the macro economy. So what we've been seeing is, you know, especially last September and October, was stimulus that was meant to juice the stock market. They wanted to get investor sentiment up. And sure, if there's a play in the stock market and the government's saying they're going to backstop you, go in. That's stimulus for short-term asset markets. If you're talking about longer-term stimulus, you know, something is actually to fundamentally, you know, improve, you know, the structure of the economy, then you have to see what they're doing. And there's been a lot of talk, but there's not been a lot of action. There's this promise now that they're going to pivot to consumption. So now everyone said, oh, well, they said they're going to pivot to consumption. So obviously consumption will be much, much better next year. You know, they've said this many times before. They've gone in and they've done little programs. The question is whether they do something, not one-off voucher here, not one-off voucher there, but something that will actually actually restructure the economy itself to being more dependent on domestic demand. They've never done that before, and most of it is actually against what Xi Jinping is trying to get at with his economic program. So, call us skeptical right now.
Leland, do you actually believe that it's totally an internal focus at a time when we're hearing about plants being built in Mexico, we're hearing about increased sales to South America, we're hearing about vehicles being built from Chinese companies in Europe in order to sell into that region? How much is this actually internally focused?
Well, that's because that's the export model. So how do you get around tariffs? You build your plants in Mexico or Vietnam or somewhere else. How do you get around other tariffs? You transship through some of these third-party destinations. So if you look back, it depends what domestic means. That's not domestic demand. What you're trying to do is double down, triple down, quadruple down on what is a manufacturing and export model. The problem is that China has the largest goods surplus in history right now. They have the largest trade surplus in history, and the model going into 2024 and 2025 has been, we are going to take our exports, which are extremely strong, and we're going to double down. And our imports, which are extremely weak, we're going to talk about doing something about them, but we're not going to actually do anything about them. So you've got enormous political friction. Even if there wasn't a President Trump coming in threatening tariffs, people around the world, countries around the world, are looking at this and saying, "Look, you're flooding us with commodities, you're flooding us with EVs." It's becoming a major political issue across the world, not just in U.S.-China relations.
Leland, how different could it look, though, if it is a transactional relationship with Trump, something that's not broad across-the-board tariffs? And I ask this especially in the context. For example, 3 days ago, Cattle announced that with Stellantis, that they're building a factory, an EV battery factory in Spain. This is something that had planned to be in Michigan, but the Democratic administration and other lawmakers shut it down because of security concerns. This is the kind of thing that maybe Trump wants. Come into the U.S., build here, and we will give you exemptions. Leland, could we see in the future, in 2025, in the preceding 4 years, this type of deal instead happening in the U.S.?
President Trump has said that if you're willing to come here and build, then we will bring you in. You'll probably get a tax cut. You won't hit tariffs. And so there will be incentives for bringing all kinds of foreign production back home. The question is whether there's a national security threat that prohibits that from happening. So when you're talking about Chinese EVs, there's a lot of talk about Chinese EVs being produced in the United States. But the issue isn't only economic, it's national security. These things are wired, shooting data everywhere. There's, the Biden administration just came out with something showing the degree to which it's a cybersecurity threat to have Beijing producing these cars in the United States. So not everything is an economic matter. I think if you're broadly speaking, if you're a company willing to come to the United States and produce, then you are going to be welcomed here. But there will be big exceptions, and there will be especially big exceptions when it comes to China.
Leland, in 24, 48 hours prior, we heard that Donald Trump invited Xi Jinping to the inauguration. China saying they're not going to go, but they're going to send a top representative. Everyone could have guessed that was going to be the outcome. But what do you make of potentially the tone this administration is going to be when it comes to dealing with China?
I find out, we've been dealing with this issue for the last couple of days because everyone's so baffled by it. Does no one remember the first term? President Trump at the same time had a very friendly relationship with Xi Jinping while he was levying a tariff war on China. There are two sides of this. So you can be very friendly in terms of how you're talking about the other leaders, and yet being very aggressive when it comes to economic policy. So I think the biggest mistake that Wall Street has been making over the last several weeks is they've been looking at a few personnel picks, or they've been looking at a tweet or two and saying, well, this must be the president moving away from tariffs. This is a president who's not going to be focused on all the things that he's been saying he's going to do for the last 2 years. Quite frankly, I think that's ludicrous. This is going to be a lot more of what the president-elect has been saying. He's going to do what he's saying, and this should be the expectation. Not thinking that a Treasury pick or an NEC pick or someone else is going to push him in another direction for where he wants to go.
Well, there's Treasury pick or NEC pick on one side, but then there's Marco Rubio, Congressman Waltz, and Jamieson Greer on the other, all three who've called for decoupling. Do you think that's the China that Donald Trump is going to be leaning into?
Look, I don't think that the economic platform for the administration has necessarily been crafted yet. You certainly have people with very different views. There are people who think that you need to have a comprehensive economic security strategy with China, which means, obviously tariffs, but also technology restrictions, investment restrictions, supply chain resiliency, defense industrial base rebuilding. And there's other people who are more focused on tariffs. This is the most important thing. We got to get the trade deficit under control. So I'm not sure that this has all been squared away. I think the president's going to listen to the back and forth, and he's going to make his plans based on what he likes at the time. But I think the mistake right now is to think that tariffs are not part of that program.
Leland Miller of China Beige Book, thank you so much, as always, for your insights. Right now, let's get you some insights into what's going on over in Europe in particular. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The UK economy contracted for the second straight month in October. GDP again fell 0.1% in the month. The economy only growing in one of the last 4 months since the Labour Party took power. The Office of National Statistics pointed to continued weakness in consumer-facing sectors, including pubs, restaurants, and retailers. Manufacturing and construction output also declined. Meanwhile, big tech's embrace of President-elect Donald Trump continues. Amazon donated $1 million to Trump's inaugural fund, and the company founder Jeff Bezos plans to meet with Trump next week. Amazon is also streaming the inauguration as an in-kind donation that's worth another $1 million. This comes days after Meta also donated $1 million to the same fund. And consumers are still going big at Costco, with the retailer reporting better than expected earnings. Membership rose at the retailer, which is known for selling items in bulk at a better value. Plus, it saw more than 7% rise in comparable sales at stores, while online sales also grew. On the analyst call, executives said furniture has fueled e-commerce sales this holiday season. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I do want to bring you some breaking news. We've been waiting for this all morning, that we have Emmanuel Macron naming a new prime minister in France. His name is Bayrou. He is a member, has been the head of education, minister of justice, Francois Bayrou. He is a moderate, and we will bring you more as we know it. Up next, placing bets for the new year.
The outlook for 2025 is almost kind of two halves. The first half, I think there's a risk to a curve flattener and to rates remaining a little bit elevated.
That's next. This is Bloomberg Surveillance.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Welcome into the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
And coming into what could be the first week of losses in about a month, but we are seeing a bit of a bounce this morning as stocks try to claw out maybe from underneath that, led by big tech once again. S&P futures up about 1/3%. Under surveillance this morning, placing bets for the new year.
The outlook for 2025 is almost kind of two halves. The first half, I think there's a risk to a curve flattener and to rates remaining a little bit elevated. As we get into later next year, we do expect some of the Trump policies, like tariffs and immigration, to really start to weigh on growth a little bit, and they will keep the Fed cautious.
Here's the latest. U.S. Treasury market volatility slumping to multi-year lows as investors increase bets on a December rate cut. But 2025 policy uncertainty creating diverging outlooks. Andrew Cizorowski of Morgan Stanley writing steeper Treasury curves, everyone's favorite trade of 2024. Now, it doesn't come with the same negative carry in 2025, so it will be even more palatable. Andrew joins us now. Andrew, good morning and welcome to the show. I just want to start there. How much are you really watching the yield curve, some of these lack of volatility types of moves, to really understand whether we could see a revival in some of the mortgage market, in some of the originations, as well as some of the transactions there?
Yeah, look, I think it's something a lot of people are looking at, and you've seen the Fed cut 3 times. We expect the Fed to cut next week on Wednesday. But a lot of people are saying, why aren't mortgage rates lower? Why are mortgage rates still close to 7% when the Fed's been cutting rates? And that's because when you look at the yield curve's been steepening over the course of the whole year. And it's something that I expect to continue into 2025. When you think about the kind of divergence between what the Fed's doing and then potential kind of larger fiscal deficits and how the bond market's going to digest that, I think it's gonna require more term premium. So investors should be compensated for going out that yield curve. That doesn't mean there's not value in bonds. I just think the value in bonds is going to come from the kind of short end to belly of the curve, and there's going to be value there.
Andrew, what difference will it make, though, in terms of just how much steeper this trade has to run if you do get a cutting cycle that's cut short next year?
Yeah. Look, when you look at what the bond market's pricing in, the bond market's only pricing in a cut next week, and then they're only pricing in 2 cuts for 2024. If you don't get those 2 cuts, then ultimately you're going to have flatter curves. I ultimately think you're going to actually get a Fed that ends up cutting more than the market's pricing in. When you look at the dot plot, and this is something you're going to get a new dot plot next week, but you actually have 8 members expecting more than four cuts next year. And you have 6 that are projecting, which is the median right now for next year, 4 cuts from the dot plot. But you only have 5 members that are actually above that median. And I think that's something important to look at going into next week is there a change in that dot plot? There might be a little more hawkish tilt there. But I think when you look at that skew, it's more likely that we get kind of closer to that Fed's projection than only 2 cuts. I think when you think about the Fed, they historically don't end at neutral. A lot of people are kind of talking about where neutral is. But I think the Fed's more than likely to go through neutral to go from a restrictive stance on policy to a stimulative one in the coming year.
Andrew, as to kind of solving the conundrum of why we've had cuts and yields have moved higher, there are a variety of reasons, deficit being one of them, the higher term premium required for that. Another thesis has centered on this idea of bond market volatility, that because there's more volatility in this bond market, there's more whipsaws. That in itself requires a higher premium too. I wonder what you make of that, heading into a 2025 too, where some of that whipsaw action, some of that narrative shift, constant back and forth, it doesn't so far have any signs of ending.
Yeah, no, look, that's a great point. I think that one of the things that's kept volatility in the bond market high over the last couple of years has been inflation. When there's this uncertainty on inflation, you should be paid an additional premium in the bond market for that. Now, in the coming year, I expect inflation to continue to subside and that volatility in inflation to continue to subside as well. And I think we're still working off some post-pandemic distortions, but I think those distortions are kind of lessening month by month, and they're going to continue to lessen in the coming year. And with that, I think there'll be less volatility in the bond market, and so maybe we'll take out some of that volatility premium in the coming year that investors should have been compensated for these last 2 years.
Andrew, how difficult, though? I know you think we're going to get more cuts next year, but how difficult is that going to be when we're seeing already the policy proposals of the Trump administration, which is tax cuts, more spending on the border? There's going to be a lot of fiscal stimulus in this economy.
There's going to be a lot of fiscal stimulus in this economy, as you mentioned. I think that it's easier to cut rates for the Fed when you're above neutral, and we don't exactly know where it is till after it's passed. But I still think we're in the kind of easy part of monetary policy where the Fed's not kind of walking around in the dark trying to feel their way around neutral. I think that it gets much tougher as we get in the kind of back half of the year. But I still think that, as you mentioned on the fiscal side, there's these large deficits. That I think there's a lot of kind of campaign rhetoric that might not ultimately come to fruition. Earlier, you were talking about the kind of the small majority in the House. I think it's going to make some of the policies much tougher when there's only a 3 House seat majority when you look at some of the members that are leaving. And so I don't think that the Trump's wish list and Republicans' wish list is going to kind of go through as planned. And I think with that's going to come deficits that maybe aren't as high as feared. And I think you've kind of seen the bond market, rally a little bit since Trump was elected, and I think that's a big part of it.
At this point, Andrew, you're bullish on the prospects of bonds. Why do you think this is going to affect long-end securities, including most mortgages, as much as the short end, which is where everybody seems to be placing their bets?
Yeah, look, I'm bullish on bonds, and I'm bullish on kind of taking credit risk, because I do think that when you look at what happened this year, look, we've had the interest rates back up actually from the kind of 3-year point on the curve and out. So there's actually more value in the bond market today. Yields are higher today, despite inflation coming down, despite the Fed cutting 3 times and likely 4 by the end of next week. And so I just think for a bond investor, when you have this, when you look at kind of where real yields are, they're still extremely attractive. And then we're not advocating just staying in treasuries, though. I think when you look at what credit spreads have come in a lot, but ultimately, if you're a bond investor and you have this kind of decelerating economy, but still a strong economy, that's not a bad environment to take credit risk. So I think that if you can get a 7% yield in a high yield bond, or a 6%, just under 6% yield in a government agency mortgage-backed security, we think those are attractive places to kind of park your money, especially when, if you were rolling your T-bills, you're going to be getting into the kind of 3-handle yields early next year. So I think, and then you think about where inflation is. If inflation's low 2%, well, that's still a very attractive real yield, and that's something that I think people should be kind of moving out that interest rate curve, moving out the risk spectrum.
Andrew Cicurowski of Morgan Stanley Investment Bank, thank you so much for being with us. And I'm looking right now at real yields of 2% on the U.S. 10-year yields. Coming up next, Jared Woodard of Bank of America, Bloomberg's Mike Shepard, Jason Thomas of Carlyle, and former New York Fed President Bill Dudley. Don't miss that on his latest column that just dropped. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
On the equity markets, I see some froth. I'm a little bit nervous.
I would expect markets to broaden out largely because the earnings differentials are likely to moderate.
You want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues.
The consumer resilience is not waning. So they still have some cushion in there across all income cohorts, high, middle, low.
The markets are confused, just as the Fed is, about the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. With stocks looking to take back some of this week's losses Friday the 13th as we look ahead to a big week ahead, possibly the last significant week of the year. Fingers crossed as we head toward that Fed meeting. Here's the state of play right now. Equity markets looking to really post a couple gains as we do face potentially the first down week of the past month, really led by the tech stocks. And this has been something that we have seen considerably over the past couple of weeks. NASDAQ 100 up 0.6%. And what you can see in the bond space, yields creeping just a little bit higher after really rising yesterday. And this highlights the uncertainty heading into next week. Given the fact that we have a Federal Reserve expecting to cut by 25 basis points, it is the reaction in markets to the signaling that will matter most. Danny, next week, that Fed meeting, there's going to be a lot of heavy lifting by Fed Chair Jay Powell.
Exactly, because we know 25 is coming. That's already been priced in. The euphoria, I think it's a net 130 cuts globally so far this year, is in this market. Are we going to get a hawkish kind of cut, where he basically signals, both him and the dots going forward, that there's going to be some sort of pause, maybe not a pause, maybe another recalibration to understand where inflation is truly going. Yields have already moved higher on the expectation that something like that would happen. Is that where the bias is? That you can, again, get another cut as you have in the past, do decisions, and yields keep moving higher.
And every analyst that comes on and says, look at the dot plot, that's what they're most focused on. They've pretty much said there's the green light for the Fed to cut in December. But the issue becomes 2025. To Danny's point, everyone seems more focused on the dot plot because how are people starting to think about on the FOMC, even if they won't say it out loud, how will they start to think about the political economy changing because of the policies that will be ushered in with a brand new administration?
How do you think they're going to do the dot plot this year? Just put a dartboard up there and throw some things? I mean, I'm
like
serious.
Spaghetti at the wall?
Yeah, pretty much.
Bill Dudley, who I'm so looking forward to speaking to later, his column came out, said basically they can only really incorporate tax cuts because the rest are unknown. I would argue why even look at the dots then? If the dots literally aren't going to incorporate two of the biggest policy proposals of tariffs and immigration, what's even the use of
some
them?
sort of base case, right, to start the year?
Here's the base case heading into next week in terms of the lineup. We're seeing retail sales coming out as well as personal income and spending. The big event is on Wednesday when we get that Fed decision as well as that Jay Powell Fed rate press conference after that decision, and a real question here about how long the consumer can keep powering the United States exceptionalism. We did get some retail earnings already. A real mixed picture, Danny, and I think that really stands out to me.
A mixed picture, but the ones that are doing well are doing really well. There was Costco yesterday, 7% increase in U.S. same-store sales. They said that wealthier people are kind of shifting down. And again, you could argue, okay, something's not right. More people are spending at Costco. Maybe that's a bad thing. But we were speaking to Holly O'Neill of Bank of America yesterday and said, yes, that shift down is happening, but spending as an overall level is higher. It's just people kind of trying to keep the cushion in their savings account, trading a little bit, but the consumer is still healthy and still spending.
Costco did very well, but one thing I picked up from the CEO talking to analysts is that people are buying what they need, potentially, not what they really want. People are very, very basic buying this year. That's what the CEO had to say.
So be bullish on toilet paper once again. Coming up this hour, Jared Woodard of Bank of America as tech lifts stocks ahead of the Fed. Jason Thomas of Carlyle on the M&A outlook for 2025 in a new report that's really fascinating. And former New York Fed President Bill Dudley on Chair Powell's Balancing Act and the dot plot during a second Trump term. We begin this hour with stocks higher, boosted by tech, signaling a positive end to an otherwise potentially down week ahead of that final Fed rate decision of this year. Jared Woodard of Bank of America seeing room to run in 2025, writing, we favor equities given upside potential from broader earnings growth, higher productivity, and deregulation. In the U.S., prioritize cyclicals with exposure to enduring themes like defense, tech, SMID, industrials, and energy. Jared joins us now. Jared, good morning. Thank you for being with us. Happy holidays. We're launching that today, a special breaking news. Jared, I want to start with this idea of a broadening out at a time where in the past couple of weeks, we've seen a real stalling in that kind of activity. What makes you think we're going to restart and go back to that idea of all of the stocks outside of the Magnificent Seven outperforming?
Well, you know, history's on our side here. If you look at the long sweep of the U.S. equity market, in the 20th century, the average weight in the S&P 500 by market cap to real economy sectors like financials, industrial, materials, energy, those parts of the economy occupied 45%, sometimes more, of the S&P 500. That was the norm. Today, they're much smaller. They're in the 20s altogether, and of course, it's tech and consumer discretionary and communications, these growth stocks that comprise almost 50% of the market. Our view is that as the policy environment shifts, particularly in the United States, as sticky inflation, the higher growth potential as well, make the value of those real economy sectors rise, investors should be positioned for a moderation at the sector level, at the thematic level, because we think there's a lot of potential from deregulation, from earnings broadening out across the economy, and for higher productivity, particularly in the United States, continuing a trend of higher productivity that started even some years ago.
At a certain point, do yields have the potential to stymie this? And we've seen that over the past couple of sessions, just question marks around the deficit, question marks just around how much stickiness there is in inflation. Where do you weigh in on that? How dependent is this theory on yields staying kind of where they are going lower?
Well, as asset allocators, we think that long-term fixed income, especially government bonds and even investment-grade corporate bonds, may not be as attractive in coming years as they have been in the last few years. You know, we've had this thesis on the end of 60-40 for a number of years now that's basically played out quite well. If you look at some of the different asset allocation approaches in the market, familiar and unfamiliar, having big allocations to long duration fixed income has been a losing move. If you look at it across the Treasury curve, many parts of the market are actually still underwater from recent years. I'm not worried about a rapid rise in bond yields hurting the equity market. I do think that we may see stickier inflation and stickier bond yields in years to come in a way that makes it more attractive to be in credit and higher yielding parts of the fixed income market and in short duration parts of the equity market, investing in companies that have real profits today, real cash flows today that they can deploy either into their businesses or to shareholders rather than waiting for companies that might not see tangible profits until far out into the future.
Jared, so you're describing a much more active approach to not just this whole market, but the bond market included in that. And we've had plenty of people come on here and say, everybody is an indexer now. The way that people are exposed to bonds are through indices. How unprepared then are investors in 2025 for what you're describing when 60-40 target dated funds and buy the whole market kind of strategies aren't going to work as well?
Yeah, this is an extremely important point because both in the equity and the fixed income markets, we look at benchmarks today, and they look more unbalanced than they've ever been. The S&P 500 is something like 2/3 comprised of growth stocks. The U.S. aggregate bond benchmark and other familiar bond benchmarks that many people use are weighted something like 70% toward long duration assets, toward assets that benefit from deflation. Now, I think a more balanced approach is going to be extremely helpful in the future. It's already been a great benefit in the last several years as investors who can weight in a more balanced way across asset classes, capture different risk factors, not just one big deflationary or growth stock type risk factor, can achieve better returns and better risk adjusted returns. That's our call for 2025.
Jared, when it comes to broader asset classes, we were speaking with Chris Ferrone of Strategas earlier, who pointed out that volatility is low in the bond market, volatility is low in the equity market, but where it's not is the FX market, and especially pairs particularly vulnerable to fiscal policy going forward. How worried are you about a broader contagion that starts and stems from currency markets?
Well, I think if we fast forward 5 or 10 years from now, we could look at one data point from the future that would be valuable to help us allocate across assets today. It would be the level of the U.S. dollar. On a real trade-weighted basis, the U.S. dollar is at the highest since 1985. It's too strong. It prevents American exports from being competitive on the global market. Just as importantly, it prevents consumers in places like Europe and China from benefiting from the wealth that they produce. A rebalancing in the global economy, a slightly weaker dollar, slightly stronger currencies elsewhere, could create the conditions for some really incredible potential growth. Alternatively, if policymakers and leaders can't find a way toward greater balance in the global economy, flows of goods and flows of capital, and the dollar remains as strong as it is, it creates the conditions for a very unpleasant, really kind of a bubble in which there's no alternative to U.S. tech and even to U.S. treasuries for all the capital flowing around the world. I think that what happens with the dollar and whether we can avoid competitive currency devaluation in the years to come is one of the most important trades and questions to answer in the market today.
But Jared, how would policies mean a weaker dollar when the ones that are coming in and being discussed right now by the Trump transition actually call for a higher dollar when you think of things like tariffs?
There's a lot of debate right now on tariffs, on many other policies. I think economic history gives a much different picture than the consensus today. Our economists at Bank of America have written a lot about this, and they suggest even if you take a kind of a standard view on how tariffs and some of these other policies might affect the economy, even in that case, it's a one-time shock rather than a persistent effect on the market, and the effects may actually prove to be quite small. I think there's actually a lot of potential for managing trade relationships, managing flows of capital that many countries have done for a very long time. The West hasn't engaged in that very much. And so the perspective of some of these Western policymakers, including the U.S., is that really we're actually trying to get back to a level playing field when it comes to